India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Morning, you're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Tuesday morning. Yesterday was interesting. A market bouncing from the day's low, but not really ending at the high point of the day either. Lots to talk about. Lots of earnings still coming through. I'm Prashant. With me, my colleagues Nigel and Shri. Guys, hi, good morning.
Hi, morning. And Prashant, I think while you were away yesterday for work, we made sure the market doesn't breach at least the lower side of the range. We did our part. We did the best we can, Nigel, don't you think?
Well, that's right. And I think overnight we have quite a few earnings surprises, at least in line. No big howlers. So I'll take that because, the last few days, again, we had a couple of big disappointments like Asian Paints.
Yes, see how we've lowered expectations. We're just happy without the howlers, happy without the range being broken. That's how it is now.
As someone said, right, the recipe for it was in the context of marriage. Happy marriage is low expectations.
Lowering expectations.
Let's get straight to the market action.
With I think you can extrapolate that for markets as well.
This is Tuesday morning wisdom.
Especially at times like this, right? Anyway, let's just quickly run you through, the stuff from overnight because I think that's what you're going to begin with. So S&P 500 has ended above the 6,000 mark for the first time ever. So that's quite something. So it was a small gain, 0.1% or so higher, but we ended at 6,001.35 on your screen. NASDAQ, again, small up. The Russell 2000, which is the small cap index, ended about 1.5% higher. So that actually was the big one. Now, remember, cash bond trading was not there because of, I think there was a Veterans Day holiday. But a few other things. Bitcoin, for example, above $87,000. Tesla, another one which jumped about 8.5%. What's common with both these things? It's, they're all part of the so-called Trump trade in that sense. Dollar continues to move higher. And I mean, the dollar index is strong and how? Of course, it doesn't particularly help that one of the largest constituents which makes up the dollar index, the euro, is find itself in a particularly tough spot. So, US is sort of, at least in terms of flows, etc., pulling away. And of course, the euro is not getting any. So 105.52, about 0.5% higher. And now we're approaching an important resistance for the dollar index, 106.5, 107.35, which are the 2023 and 2024 highs respectively. Now, oil prices, they were down about 3%. A soft outlook for demand as far as China is concerned, largely to blame. We're at about 71.7 this morning. Lots of appointments coming through and pretty fast pace, especially on things like the border, etc. From the sort of to-be Trump administration. Appointments are coming through. The big one, which markets are waiting for, are Secretary of Treasury and, of course, Secretary of State. And I think those also we should have in the next 48 hours or so if reports are to be believed. But what we've heard so far, I mean, the Financial Times, for example, yesterday reported that Mr. Trump is inviting Robert Lighthizer, who was the U.S. trade representative during his first presidency, to take the same post once again. I mean, he's an out-and-out tariff person, and he was the one who kind of designed the higher tariffs with regards to China, etc. So he's largely and likely going to be back as the U.S. trade representative. So markets will continue to be sensitive to these appointments and, of course, policy hints directly or through some of these appointments as well. Just to kind of tie in the levels here, I mean, there's not very much new in that sense. On the way down, Nifty has got support in the 24,000 to 24,100 zone, a level that I've talked about in the past as well. On the way up, the 20-day is the first resistance, which is 24,436. And then you've got the 40-day, which stands at 24,659. That's a 40-day exponential moving average. For the Nifty Bank, I mean, you're basically broadly stuck in a pretty small range, 50,500 to about 52,577. Just go back and look at the last 10 trading sessions. I mean, that's the range that you are working with. 52,577, of course, was the recent swing high on the upside. And you need to kind of take this out, get out of this range for the market to give you further cues. GIFT Nifty will come up on your screen. and should give you a sense of how we are starting 30 points higher. So you're starting small, which isn't exactly a bad thing. Shri.
Okay, so 30 points up is the pop that's being indicated. Right now, Asian markets are actually a little more mixed than the one-way move on Wall Street. Wall Street's made a habit of breaking records, 6,000 on the S&P 500, 44,000 on the Dow. But there you go. This is what I was talking about. Some of the China-linked markets, they're actually under a fair amount of pressure. The Hong Kong market opened positive, but it's turned negative. Mainland Chinese market is absolutely flat at this point in time. The only market that's seeing consistent gains is actually Japan. Japan is up about 0.5%. So Asia is getting a little muddled. That's point number one. Just talk about, of course, the range for us over here. Even yesterday, the Nifty has been moving in a 250-point sort of a band. And the larger range, the consolidation patch that we've been in is about 23,800 on the way down and 24,500 on the way up. And this is a 700-point sort of parameter within which the market has been moving. So let's see if this continues or whether we will start testing higher levels. Yesterday's FPI sell number was lower than the kind of 3,500 crores, 4,000 crores that we've been seeing in the last many weeks. So the bulls were like that. The intensity of the selling came down to about 2,300 crores, and domestic institutions were offsetting a lot of that selling as usual with buying of almost 2,000 crores. Today, beyond all the tail-ender earning action, I'm looking out for the CPI number. That could give you a big headline because the sense is that consumer inflation here in India could cross the 6% upper limit of the RBI, which is why a lot of people are not expecting the RBI to jump on rate cuts anytime soon. This is largely going to be due to a base effect and due to the fact that vegetable prices, food prices have been soaring. So let's watch for this number, whether it indeed crosses the 6% mark. The previous month's number was about 5.5% consumer inflation. Results. Okay, so the way I look at it, there's nothing that's lighting up the chart. So that's really making you sit up and take note of positive cues. On Britannia, the revenue and volume number is in line. Remember, we were discussing this with Mangalam, where the volumes can be 8 to 9%. They are 8%. The issue is on margins. There's a massive margin miss that Britannia has reported, 16.8% versus expectations of a 19% margin. It's also a major 300 basis points decline. So Britannia, that explains the nervousness as the market was getting it ready for those numbers. Jubilant Foodworks, I mean, they're in line technically, but operationally nothing great. The margin's down about 160 basis points here as well. Shri Cements, Nigel will talk more about, and I think at least that's the point that we're making, that at least it's in line with estimates. But if you look at it year on year, then things are sort of sluggish to lower. I think even here there's a bit of a margin disappointment, big crack on margins compared to last year. Bank of India is a bit of a silver lining because at least with some of these PSU names, there are no asset quality issues that are showing up. So perhaps that could be, a little bit of positivity. But overall, I guess, Nigel, we're looking at the market still being in a consolidation patch, waiting for more clarity. The US market is charging away. We didn't mention Bitcoin, by the way. Now approaching 90,000. Do you have any?
Well, the Trump effect, and I don't have any. I don't intend to have any because I don't invest in things that I can't understand, but I've missed the bus. All right, we're getting to the top cues then. The FI as well, the sell number coming in from them is the lowest that we've seen in the last few sessions, which is encouraging. The Chinese stimulus isn't as good, and the FI, the selling exhaustion could be coming up out. So I want to see whether or not that number can even get smaller or hold around these levels, which will be encouraging after the big selling that we've seen. The Nifty Financial Services Index, that'll play out its weekly expiry today. And, the dollar index, that's still holding at around the 105.5 odd mark. That's a bit of a worry. I think the key to track with regard to flows and getting far more favorable FI data is going to be this dollar index cooling off from around this 105.5 odd mark. Yesterday, we did see a bout of short covering that did take place, particularly on the Nifty Bank, because you saw the open interest that was down by close to around 2.5%, and the Nifty Bank, in fact, ended higher in trade. And that perfectly tallies in with what the FIs did. Mild short covering, 1,500 contracts on the short side were covered out, and they added some mild longs as well. So after a while, we saw a swing factor of close to around 4,500 contracts in favor of the longs in yesterday's trading session. It remained net short, but there was a swing factor in yesterday's trade. Two strikes that were active, 24,300 call, 24,000 put. Both of them, the premium around 50 to around 60 rupees. So you just plug in these numbers. And as I mentioned yesterday, 23,950, that becomes the first reference point on the downside. On the upside, you'll get confident only once you get, past higher levels, which is at around 24,350, going by the writing that we've seen at around the 24,300 call. The Nifty Bank, that came to the party yesterday. From the lows of the day, it saw a big increase. And in fact, on a closing basis, it conquered the 20-day MA. However, the 50 DMA remains elusive. So the bulls will like to get that level out of the way. And HDFC Bank of late, it's become an outperformer in comparison to what the market does. And it's holding one end up. Now it's only 1% away from its 52-week high, which is telling you leadership is back with HDFC Bank. That's why the Nifty Bank is holding strong. So let's get the levels up for you on the screen. Yesterday's high and low, they become the crucial reference points. You want to get past that mark. That's yesterday's high on the screen. I'm looking at 3 stocks and 3 underperformers of late. But the numbers, they had something to cheer in all 3 of them. Hindalco, the Novelis's numbers were very disappointing. The stock saw a sharp hit. Yesterday, the stock was a bit of an outperformer, but these numbers, India operations look good. So that one is something that we look at. Ramco Cements has seen a sharp correction from the top, but now their focus on cost is coming into play. So that one as well, after the big correction that we have seen, deleveraging as well taking place, I'll keep an eye out on that. And Britannia, massive shots in the system yesterday. Volume growth as good as expected. So all these 3 stocks will be on my radar, particularly because they've been underperformers. Can they outperform for today?
Okay, all right. So yeah, a lot of those earnings reactions will play out, and we'll keep you updated on it. Let's start off with the equity call of the morning. Rhythm Desai of Morgan Stanley says India is in the midst of a significant positive wealth shock, which we believe has far-reaching implications for both macro and markets. Even though in the short term, the market remains offered due to near-term growth concerns, he says their portfolio position is cyclicals over defensives, large caps over small and mid caps. They're overweight financials, technology, consumer discretionary, and industrials, and they're underweight on other sectors.
Okay, well, so that's the view coming in from Rhythm at Morgan. Harold van der Linde is head of Asia Equity Strategy at HSBC. Harold, great to have you with us here. Thank you very much for your time. The big talking point here, in near term at least, of course, is what's happening with the US dollar, which continues to push higher. Lots of debate about how much of this Trump trade, so as to speak, is in the price, or is it really likely to play out in a big way, which means the dollar can head a lot higher from here. What's your sense, Harold?
Yeah, no, the dollar has been strong, and that's because we've seen bond yields move higher. There's a very kind of silver lining for Asian equities in the story, and I get to that. But yeah, he's a big spender. The idea is that they would do more on fiscal spending, that might be inflationary. The markets have therefore said that might mean that the interest rates are not going to come off so quickly in the US. Bond yields moved higher, and that's attractive for the dollar, so the dollar has remained stronger. And in effect, what's happening, the money is flowing back into the US, and that's not so good for Asian equities. But bond yields are, what are they now? 4.3-ish or something like that. So they can move lower over time if these inflationary numbers start to come off, and that could provide nice support. So we've seen the US market doing really good. They will benefit from this as well, but the Asian markets eventually could benefit from this as well. And bond yields haven't really moved higher that much. They've gone, they haven't really passed the 4.5 level-ish. So I think probably most of the strength in the dollar we've seen at the moment, but it might just hover around a little bit longer in anticipation of what the policies are going to be in the US.
Harold, great to have you on the show this morning. Thanks for joining in. So as this, we love the home market trade continues, which is money piling into, mid and small cap US stocks, where does it leave a market like India? Because we have seen a continuous exodus of foreign investors. The selling has continued. The intensity has come down in the last couple of days, but they're still leaving. So what do you expect from here on? Domestic flows are very, very strong in a market like India. But what should we expect into the end of the year?
Good. So I think in the end of the year, what we're going to see is that these bond yields will remain elevated, maybe come off a little bit. It might provide a little bit of support for the whole region. If you then look at India, the story in India is a bit of that the earnings are disappointing. India's been growing very fast over the last 3 or 4 years. Earnings growth well in advance of 20%. And now what we see is actually that it's coming in well below that. I think out of the top of my head, about 60% of the companies that came through the reporting season have actually not met the analyst earnings estimates So there's a bit of a reset in Indian earnings for a variety of reasons, right? There's a bit of margin squeeze here and there in the banking systems, on the consumer names you've talked about, and these sort of things. So that lowers the expectation. I think that was the reason why the foreigners left that market. Also, this happened and coincided with things changing in China. So there was some money flowing into China. Now, will this continue into 2025? Probably it will. I think the earnings are being reset, so therefore the valuations need a little bit of reset. My worry is that if there is a particular worry for Indian equities, is that if the local appetite is starting to come down, because they see these earnings also, that they say, oh, maybe I'm not quite sure what to do. But as long as that remains strong, I don't think we're going to see a hell of a lot of downside in this market. Indeed, if these global bond yields start to fall off again as we go into 2025, I think actually support for markets such as India will come back again. You'll see probably foreign flows coming back again as well.
All right. Hi, Harold. Morning. Always good to hear your thoughts. You know, India has been the outperforming market, but of late, last 2 months or so, China has in fact outperformed India. And there's been a bit of a rotation out of India, Taiwan, out of Korea, presumably into China. Do you think bulk of that rotation has taken place and in the near term, China will still outperform? Or you believe that the structural story is India? You expect, you know, the funds come back here into India because the selling has been the most we've ever seen.
Yeah, so two things here. First of all, if you say structural story, we're looking at a longer run. So we're looking 2, 3, 4 years out. In that sense, India is a structural story. I still believe that, and in China is a trading market. I'm not quite sure where it will go 2 or 3 years' time. It could do very well, but at the moment, let's not assume that. However, the thing is that in China, the worst case scenario that was unfolding until a couple of months ago has now been stopped. What they've done is to make sure that certain payment systems in that economy continue to flow. And that is in itself means that we've probably passed the worst in China. And gradually we see things coming back. Property transactions, for example, are picking up and these sort of things. What that means for China in the moment is that I think the downside risk in that market is limited and the upside risk is pretty still okay. And therefore, in the near term, China looks attractive. In India, it's probably the other way around. With the earnings being disappointing, the downside risk is a bit there, maybe not so much. But if you then go look a little bit beyond that, I think in the long run, India continues to look better.
Well, absolutely. Harold, great speaking with you as always. Thank you very much for joining us, and it's a pleasure. Thanks indeed. Well, let's just quickly sort of move forward and tell you what's lined up here as far as the show is concerned. So at 8:30, you'll hear from Sandeep Jain and Sumit Sood of Aums Drugs and Pharmaceuticals. It's a recent listing. Mangesh Bhadang of Centrum will join in to talk about the Shri Cement second quarter earnings. We have Gautam Chachoria and Sunil Tirumalai of UBS joining in from the sidelines of the UBS India Summit. 9:30, the management of Shri Cements with their second quarter earnings. Vikas Gupta of PG Electroplast at 9:40 on their second quarter. 9:50, you'll hear from L&T Tech Services on the new acquisition that they've made. And towards the end of this our segment, it's the economy. Lata in conversation with Santanu Sen Gupta of Goldman Sachs for second quarter earnings review as far as banks are concerned.
We'll slip into a short break, but on the other side, we'll focus on a lot of stock-specific action. For the time being, we run you through the list. Hindalco, Britannia, Shri Cement, ONGC, Jubilant Food, all of them will be reacting to positive news flow. Add to the list, you have Ramco Cements, Hindustan Copper, L&T Tech Services. But two stocks will be reacting to negative news flow, NMDC and Bank of India. Slip into that break, come back, we'll get into further detail on all of these.
Welcome back. You're with us on Bazaar Morning Call, and now it's time to talk about individual stocks because we're in the fag end of earnings season. Some pretty big numbers came through yesterday, and our team is standing by with the CNBC-TV18 list of top stocks to watch for the day. Guys, good morning. So, Nigel, you go first. Hindalco?
Well, Hindalco's numbers actually were good. You know, the Novelis numbers were very, very disappointing. And post that, the India business actually has delivered a very, very healthy set. A few factors that played out here. The aluminium business, just take a look at that. The EBITDA number is much better than what we were working with, because part of their sales volume was hedged at a favorable price. The input costs were much lower. In all probability, alumina sales as well were higher, which supported the profitability, which explains why that EBITDA number is much better on the aluminium side. On the copper side of things, we'll have to find out what were the derivative gains in the past quarter, because the volumes are down by close to 10%, yet the copper business delivered a far better EBITDA number of more than 800 crores, which is the best we have ever seen. Moving to the aluminium upstream business, well, $1,350 per ton, better on a quarter-to-quarter basis, better on a year-to-year basis, and the aluminium upstream business is bulk of their profitability, so that gets a thumbs up. The debt number is more or less stable. So put everything together, after the Novelis disappointment, shots are there in the system. I expect the stock to open up well in the green.
Okay, that's Hindalco. So looking to start with some positivity. But now let's go across to Mangalam to figure out Britannia. We had a long conversation on this yesterday as well. So that volume number is not too much off the mark, right, Mangalam?
That's absolutely right. You know, a one-line summary of Britannia results would be the results are 50-50, but given the big decline in the stock price yesterday, we may see a good day on the stock today. Why do I say that? Because the volumes at 8%, you know, versus CNBC-TV18 expectations of 8 to 9% are good from an industry context standpoint, and this is probably the best that we've seen in all the FMCG companies that have reported their numbers so far. And this is also the second straight quarter of the company reporting 8% volume growth. However, the miss came in on the EBITDA front. The EBITDA came in at just 783 crores versus street expectations of 890 crores. The margins were sharply lower versus expectations. 19% were the expectations. The company reported around 16.8%, and that led to disappointment on the bottom line as well. What led to the EBITDA miss? Gross margins were down by almost 150 basis points, and employee expenses as a proportion of sales increased by about 150 basis points, and on an absolute basis as well increased by 45% as well. The company did speak about tepid consumer demand, but in that they've been fairly agile is what they said, and they saw steep rise in prices of key commodities such as wheat, palm and cocoa. Going forward, the adjacencies are something that we'll keep an eye out on. These results, like I said, 50-50, but the stock had seen a 5% decline yesterday. Should see some bit of short covering today.
Okay, all right, got it. So 50-50. Let's see if it's 50 on the red or 50 on the green side. Well, back to Nigel. Nigel, Shri Cements.
Well, as you said, Surabhi, we have lowered our expectations. Numbers in line are good. So Shri Cement's numbers were bang in line with what we are working with. On the top line, there was a bit of a miss is what we saw, but otherwise the operational performance was in line. How do they manage this? The cost of production per ton, that's come down by close to 8% on a year-on-year basis. And also it seems in the past quarter, they focused more on value rather than volume. So though they delivered a degrowth in terms of volumes, you had their realizations that was more or less flattish or down closer around 2%. So since the numbers were in line, the volumes were as weak as expected. I expect the stock to open up more or less flattish or mildly in the green. In fact, we'll be speaking to Mangesh Badang of Centrum Broking later on. He'll be joining to tell us Shri Cement's earnings. And then later on, we'll also have the management of Shri Cement, who will be joining us to detail how was the past quarter and more importantly, how are things shaping up from here on.
All right, so that's Shri Cement's management a little later here on the program. But more numbers came through. ONGC reported. Sonal is standing by with details. Sonal, good morning.
Good morning, Prashant. Well, operationally, it was largely inline set of numbers. If we talk about the numbers versus the poll, revenues at around 34,000 crore rupees, margins came in at 50.3%, which compares with 51.7%, which the street was expecting. Profits were higher by around 3,000 crore rupees. That was because there was a component of higher other income. On a quarter-on-quarter basis, revenues are down 4%, EBITDA is flat, profits are up 34%. That's because other income has doubled to levels of 4,700 crore rupees versus 2,000 crore rupees. Now, the important and positive update is that the company said they started 3 new oil wells in the KG Basin in late October, which has doubled the production to 25,000 barrels per day versus 12,000 barrels per day. This was an investor concern, and this seems to be getting addressed. They will also be starting 5 new wells shortly in that region itself. The oil realization absolutely in line with estimates. The conference call is at 3:30. So more color on production guidance, both for oil and gas, is something that the street will be watching out for.
Okay, all right. Thanks a lot for that, Sonal. Well, I'm looking at NMDC, and actually the EBITDA number that they delivered was a little lower than what we were working with, which goes down as a disappointment. And that's why I'm expecting the stock to open up in the green, in the red, though it can recover into the green. So the stock opens up in the red and then it recovers into the green is what I'm expecting. Why was the miss on the EBITDA front? The gross margins, they were under pressure. There's a stock adjustment that we're seeing. Basically, they've sold some inventory because the production number is actually lower, but the sales volumes is higher. So because of that inventory adjustment, that's why the gross margins are under pressure. Other expenditure as well was much higher, as well as the selling expenditure was higher. But the way ahead seems to be positive because they've taken 2 price hikes in the month of October. And also they've given a sweetener by announcing that adjustment, that bonus share, 2 shares for every 1 held. So because of that, the stock could recover from the low of the day, but otherwise the numbers go down as a bit of a miss. But Mangalam, coming back to you, Jubilant Foodworks, how was it?
Well, a good pizza party, especially from the delivery standpoint. So strong internals coming in. If you look at the revenues, largely in line with street expectations around that 1470 crore mark. EBITDA as well, not too far off from estimates. 287 crores. The street was working with a number of 284 crores. And the net profit at 52 crores, absolutely in line with expectations of around 55 odd crores as well. Now, here's where the strength lies in the internals. One, Domino's India like-for-like growth has come in at 2.8%, the higher end of the expected range of 2 to 3% itself. They've added 50 new Domino's stores during the quarter versus expected 45 new stores. And the average daily sales of mature Domino's stores is now at 80,185 rupees, which is at a 6-quarter high. Additionally, delivery revenue has grown by 15.9%. That accounts for nearly 70% of their India channel sales. Delivery also is a high-margin business. Dine-ins have declined, and that's a secular trend. Delivery like-for-like growth has actually been 11.4%, and that's a positive, which is what makes me expect the stock to be in the green today.
All right, Mangalam, thanks for that. Well, I'm looking at 2 more stocks, Ramco Cements as well as Hindustan Copper. Let's go with Ramco Cements first. These numbers look good. The top line was bang in line with what we were working with, and the EBITDA number was much better. How did that happen? The volume degrowth was less than expected. It was down by close to around 2.5%. We were working with a number of close to around 5% degrowth on a year-on-year basis. Also, their focus on the cost side is holding them in good stead. Power and fuel cost was down by close to around 20%, or they're using a higher amount of WHRS, which is waste heat recovery system. Also, green power is what they are using, and because of that, the costs were relatively lower in comparison to what the street was working with. Not just the operational performance, they're also deleveraging their balance sheet. So the debt is at around 5,000 crores, but they've mentioned that more than 350 crores of non-core assets is what they've already sold. So going ahead, things will improve on that front, and they're committed to deliver the 1,000 crores of sale of non-core assets. So the balance sheet as well will look a little bit better. In addition to that, they're saying that they're looking at increasing their capacity. And as we know, in terms of adding capacity, they add capacity at the least cost. So going with green out here, it's been an underperformer, but Ramco Cements will gap up today. Moving to the other stock, Hindustan Copper. Well, those numbers are fairly okay. Don't have estimates on this because not too many analysts or no analyst actually tracks it. But the revenue growth was good. The EBITDA number growth as well was good. There was some margin compression, but that's because of the adjustment in inventories. Otherwise, these numbers look fairly stable. The problem is the dollar index is stronger and copper prices have declined. But otherwise, going with a tinge of green because these numbers were not too bad. But let's wind this down with Abhishek on Bank of India. Abhishek, take it away.
Well, it's a mixed set of numbers coming in from Bank of India, but more on the weaker side. So despite the fact that credit deposit ratio is at, best in last 38 quarters, coming in at 77.4%, it has not helped the net interest margin. So net interest margin has declined on a sequential basis, and it's one of the lowest that you are seeing in last 9 quarters, coming in at 2.82%, a decline of 25 basis points on a sequential basis. Now, slippage ratio or formation of bad loan ratio, that was at 1.7%, which is the highest in last 5 quarters. The low-cost deposit ratio that continues to decline. It has come in at 41.2%, perhaps one of the lowest that you are seeing in last 15 quarters. The asset quality has been one of the best in last 38 quarters, coming in at a gross NPA ratio of 4.4% versus 4.6% in the previous quarter, thanks to healthy recovery and upgrades that they saw in this quarter. Now, SMA 1 and 2 or loans overdues between 30 days to 90 days, that shot up massively to 0.94% of the loans versus 0.29% of the loans in the previous quarter. This is at a 11-quarter high. So core operating profit or operating profit X of treasury, that shrunk sharply by 7% YOY and about 2.7% sequentially. PNL, the NI was a miss on Morgan Stanley estimate. However, healthy treasury gains that they saw in this quarter helped the PAT beat Morgan Stanley estimate. Back to you.
All right, Abhishek, thank you very much for that. That's Bank of India in terms of numbers. L&T Technology Services is the next one we want to focus on. There's an acquisition. Rima is here with details. Rima, morning.
Hi, good morning. So L&T Technology Services has made an acquisition where they will be spending $110 million in cash to acquire a company whose revenues were about $96 million as of calendar year 2023. It boosts their capabilities, it increases their presence in the fast-growing fintech retail space. And also remember, the company has a goal that this year their guidance is 8 to 10% top-line growth. So this acquisition further strengthens that guidance. Back to you.
Okay, all right. So we'll watch out for L&T Tech Services as well. And we'll be in conversation with the management as well. Amit Chadha from the company will be with us at around 9:50 a.m. So don't forget to catch that. All right, let's quickly recap our list of stocks to watch. The ones on our list that have positive news flow around them are Hindalco, Britannia, Shri Cement, ONGC, Jubilant Foodworks, Ramco Cements, Hindustan Copper and L&T Tech Services. The ones with negative news flow are NMDC and Bank of India. Okay, so that's the stock list. Quick check on the commodity market action overnight. We have Manisha joining in. Manisha, forget commodities. It's all about cryptos, right? What's going on? Bitcoin now almost at $90,000.
Oh, well, absolutely. Just inches away from 90,000. And the markets do believe that it would be this month itself that you could be looking at that 1 lakh magic number as well. But it is going to get stuck between 90 to 1 lakh is also what the markets say. Having said that, yes, it has gained 30% since elections, 42% in the last 1 month, and 90,000 already at Bitcoin. But the money really seems to be going into the dollar index and Bitcoin at this point in time, because these are the two asset classes which are very, very strong. And when you look at commodities, we have seen declines continue today as well. Overnight, we did see crude oil prices decline by 2.7%. Well, there is China demand concerns. There also are concerns on what the Trump policy would be in sense of China and oil and gas. And the projected supply growth for next year also seems higher from OPEC and non-OPEC. That has continued to put pressure on crude oil prices. It's not a different scenario for metals also, because gold is extending decline to a 1 month lows right now. The strength in US dollar is weighing here. Silver is trading at a 2 month lows. In the base metal prices, you have copper at 2 month lows, aluminum at 3 week lows, zinc at 6 week lows as well. So when it comes to energy, industrial commodities, precious metals, almost everything is going down in profit taking with the strength in US dollar and the money flowing in various other asset classes.
All right, and Bitcoin. Manisha, thank you very much for that. So that's the quick check as far as commodities go. Well, the other big cue for India, which I think is going to be especially in focus, is India's October consumer price inflation numbers should be out by 4 p.m. The NSO sort of releases it. A CNBC-TV18 poll sees the headline CPI number at 6% compared to 5.5% in September. But if the number is that, how should you read it? What's the context, the background? Lata is here with that important bit. Lata, morning.
Good morning. 6% is not a very nice number. What if it were a little higher? Remember, the MPC's limit is to keep inflation between 2 and 6%, 4% plus or minus 2. So an above 6% number can be pretty bad. Largely, the culprit is going to be food. The food price index is expected to be higher by 10%. Core index is not falling anymore. The base is, the base effect is over. So that will come at around 3.6 or something, core inflation. But food is largely because of what you call the top vegetables. Tomatoes, onion and potatoes, extremely expensive in the month of October. And that will show up. It's very unpleasant if it comes above 6%. But the only point I want to make is that this will be a one-off, because winter vegetables normally start falling off. We've had good monsoons, so there should be some kind of an impact on cereals and pulses as well. So this could be a 1 month aberration. But look at the Reserve Bank when it goes into the policy making on December 7th. The 29th November GDP number would have come. That the average is coming at around 6.6 or thereabouts. Imagine if it turns out to be 6.5 also. You have inflation above 6 and growth at 6.5. How it puts the Reserve Bank in a fix. It's very difficult to cut rates at a time when inflation is above your mandated number, and yet growth seems to need some help. So it's an unfortunate position that the Reserve Bank is in, but I think this is the least of their problems. There will be more global issues to tackle with, and therefore this will be a run-of-the-mill policy. One just hopes that this remains a one-off inflation number.
Okay, all right. Lata, thanks very much.
That's the IIP number.
And that's the IIP that will also come out, right?
Last August was a disaster at minus 0.1. September may be a little better, but well, anyway, no one's looking at it. 2 lag data.
CPI, I think, is the big one to see if we breach that 6% threshold that the RBI has put in place for itself. So important one. And the timings have changed. 4 p.m. now. Data comes out at 4 p.m. instead of 5:30 as well. So plenty to track today. Thank you for that. Let's take a quick break. We'll come back on the other side and then we'll have Sandeep Jain and Sumit Sood of Aums Drugs and Pharmaceuticals to talk about their second quarter performance. Welcome back. Well, lots of earnings to go over as the season is drawing to a close. The first company on our radar this morning is Aums Drugs and Pharmaceutical. Now, it was a bit of a subdued quarter, the second quarter gone by. The company kind of underperformed expectations in the CDMO segment. We have Sandeep Jain, MD of Aums Drugs, with us to talk about the performance and, more importantly, the outlook going forward. So, Sandeep, good to have you on. Thank you so much for joining in. I'm just pulling up the numbers as we start. At a headline number, the revenue is down about 12.5%. And there's been margin pressure as well, right? And there's a lot of weakness in the CDMO segment, which is your largest segment. Here, not only is the revenue down, your margin has come down from almost 18% to 14-odd%. What happened?
Actually, there was in Q2 last year there was a special income, whereas we got 82 crores rupees from R&D income. And that is not there. That is not a regular income which is there always and every quarter. We will not get that kind of income. We are getting so many incomes from this R&D on a regular basis, but that huge amount was for the specific quarter. And this quarter we didn't have that kind of order. Otherwise, if you just talk about the CDMO business, that is growing very well, and even we are maintaining the if we just reduce that 82 crores, even the revenue will be almost at par. And we are even more in terms of EBITDA.
But okay, fair. I mean, if I simply take away the base quarter impact, then you're saying you will be almost year on year, you will be at par. So give us a little more projections into what investors can expect from your CDMO business. What is the kind of run rate that you're expecting for the year as a whole? How much could the growth be? And also margin. What's the steady state margin for this business on a full year basis?
Around 15%, as we have already said. We will be in a position to say, as far as CDMO is concerned, we will be in a position to maintain that same around 15% gross this EBIT margin.
Okay, all right. Hi, Sandeep. Good morning and good to see you in. This is Nigel on this side. Even if I take away the 82 crores, still it appears like it will be 855 crores versus 950 crores. So actually, there's still a degrowth in the CDMO business. Explain this to us, and also if you could tell us what is your current market share in the domestic CDMO industry. Please go ahead.
Our this market share is remaining is same as last year. Last year it was 29.4%. This time it is 30%. Presently we are holding this market share. And as far as this revenue is concerned, because the API prices have gone drastically down, so many APIs have gone down. So and we are a cost plus model. That's why the revenue has gone down. Otherwise, if we talk about the volume, we are almost at par.
No, but why is there? Okay, so one reason is API, because there's no growth. And what's the outlook?
We are a cost plus model, and generally the prices are stable. But this quarter or last two, 3 quarters, we are seeing that last 2 quarters specifically, the API prices have gone drastically. Even a few of the APIs have gone around 50% of the total pricing.
But what about the outlook, sir? You've explained to us what happened in the second quarter, but are API prices still that low? Will you grow at all this year in this business?
See, as far as our margins are concerned, we are at the same margins, but because the cost got gone down, that's why the margins gone down. And we are seeing that we don't see that there will be too much of say price hike in terms of API in the current quarter or in the say Q4.
Okay, all right, Sandeep, if you could help us out for FY25 on the whole, on an average. How will FY25 look in comparison to FY24? As you're mentioning, there were a couple of quarters where you got a one-off income in FY24. So give and take everything, what will revenues in FY25 look like in comparison to FY24? Out of that, how much will exports contribute? And blended margins, what will they look at? Very simple 3 numbers: revenue growth, exports, as well as margins.
See, well, we don't want to give any guidance, but it will be as the Q1 and Q2 has gone, the same will be there in Q3 and Q4. As far as our revenue is concerned, export is concerned, we are around 4.8% to 5% in terms of export, and we will be in a position to maintain that same 5% of the total exports revenue. We are going for 2 more plants for European GMP. That is a separate issue, and we have filed few dossiers for exports, but that will take little time.
I'm just looking at it. It appears at the halfway mark you're more or less flattish, on the revenue front. So FY25 revenues will be flattish in comparison to FY24.
See, as far as revenue is concerned, I think that it will remain be flattish. But as far as the margins is concerned, I think that we will be in a position to maintain the same growth.
And just a word on your branded generics and formulations business, because I think in the call you mentioned that you are not too keen on it. Can you just tell us, when are you looking to keep the business, grow it? Are you looking to sell it? What's the plan?
No. There is no such plan to sell any business. It was that our main important business, our core business, as far as our revenue is concerned, 78% of the total revenue comes from CDMO business. That's why we told that our main focus is a CDMO business. But it doesn't mean that we are not focusing on the other business like marketing. We are very much focused on this marketing business, and one of the family member take care of that as well.
Okay. All right, Mr. Jain, we'll leave it on that note for this quarter. Thank you for joining in. Thank you. Subdued trends at Aums Drugs in the second quarter. Well, let's go back and look at the market setup. We have now Anuj joining us in the studios. Anuj, morning. So it's been range-bound consolidation. What next, do you think?
Morning, Surabhi. And you know what? Yesterday, the market rewarded both buy on dips and sell on rally trade, which is a good sign that the market is respecting some key levels. And the best cue this morning is we are not waking up to any accident like we have been doing almost on a daily basis, yesterday being Asian Paints. This morning, most earnings, they might be bad, but they are at least better than market positioning. Case in point, Britannia, like Mangalam was saying, Jubilant Foodworks, the internals look good. So some of these numbers on headline might still be a miss, but at least internals are looking okay, and compared to the market positioning at least. Good numbers from Hindalco and Ramco, as Nigel was saying. In terms of other cues, crude's down to $72. That's also on balance a positive because we had recently seen $78. And the most important cue yesterday, the FI selling was lowest that we have seen in the last 30-40 days. X of that Morat day, of course, which hardly matters, but that is important. In terms of levels to watch, then on the Nifty, the first support is 24,000 to 24,070, the low of last 2 days. And then the bigger support is 23,800 to 23,850, thereabout, the recent low. If there's a rally, then the resistance would be first at 24,270 to 24,350, the high of last 2 days. And then the well-documented 20-day exponential moving average, 24,500 to 24,550. That's where the Nifty slipped from in the recent run as well on the day of that Donald Trump win. On the Bank Nifty, it's actually one shade better than the Nifty, and it's showing signs that it's not just protecting the 100 exponential moving average, but also trying to break out. The Bank Nifty needs to cross 50 to 600 for a big rally because that's where it's been stopping for last many days. The resistance is 52,000 to 52,200, and then, as I said, 52,500 to 52,600. The support will come in first at the 100 exponential moving average, which is 51,200 thereabout, and then the October lows of 50,200 to 50,400 or thereabout. The problem for the market, though, has been market breadth. That has been weak for quite some time now.
Okay, all right. Absolutely, Anuj. And you're in sync with what you're saying, that now our expectations are lowered. That's what we were discussing earlier on. So not seeing too many earnings shocks today. Well, with that, let's take another quick break. But as we take the break, here's an announcement. As CNBC TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC TV18 Global Leadership Summit on November 14, starting 10 a.m. onwards. A power-packed day with several panels focusing on India's economy, the digital landscape, markets, entertainment, and a lot more all through the day, only on CNBC TV18.
Welcome back. Well, let's focus on a couple of companies then. We have Amnish Agarwal, Head of Research, Prabhudas Leeladhar, who joins us. Hi, Amnish. Thanks a lot for joining in. What do you make of Britannia's numbers? The stock went into the numbers very, very nervous. The EBITDA number is lower. Volumes, though, are in line. And, we just had a flash on the screen that there's a one-off in the employee cost. So adjusted for that, it appears that the EBITDA miss as well is not too large. What's your view on the stock?
You see, the volume growth at 8%, it was perfectly in line with what we anticipated. But at the gross level, there has been a decline of around, say, 160 bips. And if you adjust that, there was some, you can see, increase in other operating income to the extent of 59%. The gross margin dip is approximately 240 bips on a standalone basis. Now, if you look at, say, particularly the increase in the palm oil prices, then over the last 6 months, there has been 25% increase, and the duties have also been increased recently. So I think the RM inflation is yet to play out fully. The volume growth is in line with what we anticipated. And yes, I agree that when we looked at the numbers, we also sense that there is some one-off in the, you can say, staff cost. But having said that, I think the environment in terms of margins and profitability, that remains challenging in the near term. But the stock has also corrected quite a bit already.
Okay, so that's Britannia. So, Amnish, hi, morning. Does that mean that you would advise a buy here?
We will wait for the management commentary, because what has been happening is that, for example, there's a difference between volume growth and pack growth. And while the volume growth has been, say, around 8%, 6% in the previous quarter, I believe the number of packs which the company is selling may be on the slightly lower side. And secondly, as I said, that the entire impact of your RM inflation, that is yet to play out. That is one. And the second thing is the overall demand scenario doesn't look to be that comforting at this point of time. So it's a good stock to hold, I would believe. Yes, one can look at buying the stock on lower levels, but one will have to take slightly longer term viewpoint, because the scenario seems to be quite challenging for the entire consumption space, at least in the near term.
Okay, that's Britannia. So you'll wait and watch on this one. And Amnish, since we're talking consumer stocks, your view on Asian Paints? I mean, there I don't know if the market's not in a very charitable mood, because I think there the issues seem to be more long-term in nature. But your thoughts?
Asian Paints, I think the biggest surprise has been first that Asian Paints decorative volumes are down by 0.5%, whereas all the other competitors, which much lesser market share, they have grown volumes anywhere between 3 to 4%. Secondly, I think even in the current quarter, the confidence doesn't seem to be there, a very sharp rebound in volumes. That is one. And secondly, I think they have also given some sort of increased rebate and discounts to the dealers. And I think if that is, I think, the main worrying factor, because the distribution has been the biggest strength of Asian Paints over the years. And if now that is changing, and the fact that I believe they have lost some market share also, I think it is something which will require, say, some fixes at certain ends. So I won't say that there is going to be a very sharp rebound as far as Asian Paints fundamental performance is concerned. And given the fact that this year we might see, say, 15-20% cut in EPS, and after that a slow recovery, I think it is not, I think there are still a lot of things to happen as far as your paint industry and Asian Paints in particular is concerned.
Amnish, hi, morning. Any single stocks you're getting excited about after the fall?
Is it not in the, I would say, the current ones where you can say the results have come. But if I look at, say, in consumption space in particular, I think Titan is a stock to watch out for. Because the current quarter is also, I think, as per the commentary, going fine. The gold prices are also correcting. The margins, I think, they have already corrected. The new normal seems to be anywhere between, say, 11.3, 11.4 to something like 11.78 over the next 2 years. So I think the Titan, after correcting by, say, 20% from the peak, with the gold demand being good, plus your watch is also doing well, I think Titan is a stock which one can contemplate accumulating. And the broader consumption space, if you look, I think M&M is a stock which you have been liking. The volumes have been good. Even the tractor demand has been strong. And I think that is one stock one should watch out for.
Okay, all right. Amnish, what about Hindalco? You know, Novelis came in with a howler, and that's why the stock took a sharp knock because of uncertainty on the EBITDA per ton front. Normally, the street was hoping that $525 per ton will be maintained. But now the India operations are looking good. Alumina business as well is looking up, and the aluminum business, you know, clocking very, very healthy EBITDA per ton. Your view on the stock post the recent correction? I think the high was around 770. It's down to around 650.
Okay, you see, the main thing in Hindalco is that these negative surprises, which sometimes are like your one-off kind of item, they now continue coming every quarter or so. So that is the reason market is slightly jittery. Yes, domestic business is doing well. And I think the Novelis also, I think maybe next year, once your new capacities and all come in, I think the things should start looking up. So at the current level where the stock has corrected and given the strength in some of these precious metals, and Hindalco is a stock which one can look at accumulating.
All right, Amnish, you know, we'll take a quick commercial break here. There's 5 minutes to go for the pre-open session. We're going to come back with, of course, more opinion, some technical views as well on the other side. Stay with us. Okay, welcome back. There's 3 minutes to go for the pre-open session to kick off. Let's get in our technical experts to weigh in. Mitesh is with us, and so is Sudarshan. Gentlemen, good morning. Great to have both of you here. Thanks very much. Mitesh, you go first. How are the Nifty and the Bank Nifty charts looking, and what's the trade this morning?
Good morning, Prashant. Yesterday, you know, I talked about the fact that 24,000 would be a key level to watch, and we did get a bounce back from those levels. I think today, again, I'll look at those levels. The only idea is that we are oversold on the hourly and hourly charts, as well as looking at the PCR data. There's a chance of that happening. But in case we start breaking below 24,000, then I think we'll look at further decline. So yesterday, you know, when there was a gap down, I advised buying, exploring longs around this 24,000 mark. Today, we might open nearly flat. But again, during the day, if you get a dip closer to about 24,050, 40 levels, then I think that will be my entry point with a 50, 60 point kind of a stop. And on the upside, the first level which I'm watching is about 24,450 to about 24,500. Though there is mild pivot at about 24,250. But the idea is that we'll explore longs and declines.
Got it. Okay. All right, Mitesh. What about you, Sudarshan? How will you approach trade today? The GIFT Nifty is suggesting a 30-40 point bump up.
Yeah, good morning. See, my view yesterday was that we should be looking at a 100-150 point dip to buy. That view continues. We must be buyers in this market, and the reason is very simple. For the last 3 weeks, the Nifty has actually been in a trading range with roughly 23,800 as support and 24,300 roughly as resistance. Now, this trading range will not last for long. It will break either on the upside or on the downside. While we are in a range, we have to decide the direction in which the likely move will come. That is up, because world markets are cheerful and we are in a seasonally bullish period. So on the side of the bulls, look for sharp corrections and be long in that. Your stops in any case are 23,800. With that level, be a buyer.
Okay, all right. Got that. Be a buyer on a dip. Sudarshan, you go first. Tell us individual stocks. What are you looking at?
I have one short selling idea, and that is Glenmark, and see how it has converted itself from a long to a short so quickly. But whatever. Glenmark is an intraday short with a stop over 1685. The rest are all buying opportunities. HCL Tech from the IT pack. Actually, yesterday, everything in IT went up. So it's a matter of choosing one of them. HCL Tech is a buy with a stop under 1830. Power Grid, which has finally come out of a decent correction, is a buying opportunity with a stop under 312. A United Spirits, which has come in my list after a long time, is a buy with a stop under 1445.
Okay, all right, Mitesh, and let's wind this down with your picks for the day.
Morning, Nigel. As Sudarshan said, if we look at the same chart, I have Glenmark as sell as well, and that's the only sell. Keep a stop at 1650 to look for a target of 1600 or below. And on the buying side is Oracle Finance. Disclaimer, I have some futures positions, so there's vested interest. OFSS is a buy with a stop below 11650 for targets of 12,500. A buy on City Union Bank, which is giving a pullback. So keep a stop at 171. Look for targets of 182. And also buy on Coromandel Fertilizers with a stop below 1710. And look for targets in the range of around 1800 plus levels.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's focus on the cement space then. We had a couple of numbers that came out yesterday. The erstwhile leaders, in terms of profitability, in terms of return ratios, Ramco as well as Shri Cement. And Ramco's numbers were better than expected, while Shri Cement's numbers were pretty much in line, though the stock has seen a correction from the top. Mangesh Badang, the Senior VP Research at Centrum Broking, join us on the show. Hi, Mangesh. Good morning. Good to see you in as always. Mangesh, Ramco's numbers, let's focus on that first, because the EBITDA number looks very, very good. And the debt reduction as well is taking shape. But we know we have two big players that are making their presence felt in South India. So Ramco's dominance could be challenged, because you have Ultratech that's going to make its presence felt, and the Adani Cement as well. What's your view on Ramco Cements? It's going to open up higher. I think it's up already 4% in initial pre-open. But your take?
Yeah, as you rightly said, Nigel, Ramco numbers were fairly good. Especially given the fact that we have seen such a weak numbers across all the industry players. And specifically for South, Ramco actually had a very sharp correction in realization, but they were able to report very good EBITDA just because of better cost. So they've been able to control their cost substantially, and that has resulted in the beat. In fact, Ramco's EBITDA was 26% ahead of our estimates, whereas if you see the rest, we have largely seen that mostly the numbers have been below what we were building. So very good numbers, and debt reduction, basically what they are looking to do is looking to sell their non-core assets worth 1,000 crores. And as a first tranche, they have actually, they have got almost 375 crores through the sale of stake in Ramco Industries. And that's the first step towards this deleveraging that they are going to go ahead with. So positive steps, but as you said, southern region as a whole, pricing and competition is very high. The Ultratech, Adani getting bigger is actually a positive for the industry over a longer term. But for Ramco, what we would look for is faster deleveraging, because leverage on the books right now, given the kind of competition there is a risk.
Okay, all right. So what is your current rating on the stock? It's going to open up at around 900 rupees, it appears so.
We have an ad on the on the stock. So our target price is close to around 860. But as I said, once they do this non-core asset sale, probably there could be some upside to it.
The target price is what? I missed that.
860.
860. All right. So it's going to be opening up above that target price as well. What about Shri Cement? When I meet Mr. Bangur, I always ask him whether he's missed, some kind of, he's missed out on this inorganic growth, because the industry has been focusing on that. And Mr. Bangur has not really participated. Shri Cement has missed out on the action on that front. What's your view on the stock? The numbers look up here pretty much in line. The stock is at around 24,500 rupees. Valuations not very cheap, but not as expensive as what we've seen in the past. Your view?
Yes. So, Shri, definitely they go for organic growth more. And in case of inorganic growth, the kind of expectations they have, the return or IRR expectations, very difficult to meet in cement industry, given the kind of run for assets that we have started seeing. Anyways, their utilization this quarter was only 56%. So they have added capacities, and now the ramp up will start. And in fact, they are in the process of adding more capacities. So we're expecting them to reach close to 70 million tons soon. They would tend to, they generally used to grow at a higher than industry volume growth. But of late or for this year, they have set a target that they would be growing in line with industry because they don't want to impact realization too much. Once demand environment improves, I think they would come back to good demand growth. But yes, they have missed on various opportunities because in fact, even if you look at some of the assets that have been sold like Penna, Sanghi and the valuations, they are at par. No, basically you'll not be overpaying too much and you'll get more capacity as well as market share in new regions. So that's definitely Shri has missed. But anyways, the organic growth story continues.
Got it. And your official rating on the stock?
So we have reduced on, we have add on it currently, and 25,662 is the target.
Okay. Mangesh, how are you placed right now? You know, there was a year and a half ago when people were looking at these smaller cap companies or mid-sized companies because the larger names would have gobbled them up. But at current reckoning, given that pricing is not improving too much and the larger companies, it seems, they at least have that benefit on the cost side. WHRS systems, they're focusing on green energy as well. So they're keeping costs under control. Would you stick to the large cap names in comparison to the mid cap? And yes, what is your pecking order?
Yeah. So most of the companies, the larger ones, generally sell their cement in tier A or category A brands. So they generally tend to get a relatively higher premium. But if you look at it in terms of cost structure, it is very difficult to separate. So even though all these companies have taken steps, but in terms of cost per ton, I think, there is not too much of a difference. But large difference for EBITDA per ton gets delivered through better realization that these good brands get. Plus the kind of, the trade mix or the retail sales or the trade sales that they do. That also helps them deliver higher EBITDA per ton. So definitely the consolidators in the industry, likes of Ultratech and Adani, are the ones which are on our radar. And that's because, we are expecting them to gain highest market share. So the likes of Ultratech, Adani have delivered 2 or 3 asset purchases in the past 1.5 year itself. They are gaining market share at a substantially higher rate. So smaller players will find it difficult to match those. That's why I think the preference is for larger players. And within the smaller name, I think there are certain valuation or, return to volume growth kind of a story. So in the larger ones, we like Ambuja and Ultratech. And smaller ones, currently the only stock that we like is JK Lakshmi. And for, basically we have a neutral or kind of add or reduce kind of a rating. Or the view is neutral on JK Cement, Ramco and Shri.
Got it. Okay, all right. Mangesh, we'll let you go at that. Always good hearing your thoughts. Preference for large cap names in comparison to some of these mid-sized companies, and quite positive on both Shri as well as Ramco Cements. For the time being, I think both Shri as well as Ramco have opened up in the green in reaction to its numbers. But I think the pizza party is underway because Jubilant Food is one of the biggest gainers in a pre-open. That stock is opened up with a gain, is likely to open up with a gain of close to around 4%. Well, Mitesh Thakkar is back with us for the 9:10 call. Mitesh, what's the call?
I'll go with a buy on City Union Bank for targets of around 182.
All right. Sudarshan, what about you?
Consider buying Power Grid with a stop under 3,112.
Okay, got it. All right. Thank you, gentlemen, for those calls. Just a quick check on the screen. The pre-open is giving us an 80-point up move right now on the Nifty. And I just want to quickly do a check on, say, a stock like Britannia, whether the worst of it was priced in. Yeah, absolutely flat on Britannia right now after that 5-6% fall ahead of the numbers yesterday. So it's looking quite okay. Mid-cap, Nifty, Bank Nifty, all in positive territory as we start off. Some important stocks to keep on the radar. Nigel, let's just go back and revisit Hindalco on the numbers.
Hindalco's numbers were good. Novelis's numbers were disappointing, but the India business has delivered very, very good numbers. And for Hindalco, we track both the segmental income as well as the EBITDA number. And the aluminium business, which includes the alumina business, well, those numbers were much better than what we were working with. How do they manage that? Well, realizations were good because close to 22% of their total sales mix is hedged at around $2,550 per ton or thereabouts, which was relatively better. Input costs were lower, so that explains why the aluminium business did well. The copper business will be interesting to see whether or not there is any kind of derivative gains, because the volumes are down by close to 10%, but the EBITDA numbers looking blockbuster. Every time I speak to the management, they talk about the EBITDA for copper business holding at around 600 crores odd. But it's much better as the screen is telling you. On the aluminium business as well, the EBITDA per ton, it's improved substantially. Now it's holding at around $1,350 per ton. The net debt number remains more or less constant, but because the stock has seen such a sharp correction, the street will be very pleased to see that the India business has delivered much better. So that's why the stock has opened up higher in pre-open.
Okay, all right. Nigel, thanks very much for that. 2% higher. By the way, look at the pre-open session go. We are, actually, that's the end. We've finished the pre-open and the Nifty is up 80 points. So there is a bit of a lift coming, continuation of the up move that we saw yesterday as well. So that's a good start. Absolutely. 24,225 on the Nifty is what you've got going. UPL is the other one we want to focus back on. Sonal is here with that. Sonal, morning.
Good morning, Prashant. Well, the company reported weak set of numbers yesterday. The losses widened, but they have maintained their FY25 guidance. EBITDA growth of 50% is maintained with operational cash flows at around $300 to $400 million. And they are also looking at a revenue growth of 4 to 8%. In their conference call yesterday, they also indicated that they're expecting strong margin growth in the second half of FY25. They are expecting growth across most of the regions that they operate in as well in FY26. Destocking nearly complete. Normal ordering is in progress now. And pricing pressure, that continues because of overcapacity in China, something that other companies have alluded to as well. Importantly, on the right side issue, they have reduced the size from $500 million to $400 million, and they are yet to receive any feedback from the regulator on the same. But this is something that they will continue to look at to reduce debt. For FY26, they are looking at a volume growth of around 5% and expecting a growth in every region. So some positive commentary coming in from UPL there. On the back of this, Nuvama says that now the rights issue and potential unlocking from Advanta, that would strengthen UPL's balance sheet. That continues to be a concern. On the back of this, they've gone ahead, increased the target price to 590 versus 486 earlier. They've also upgraded the stock to a buy from a reduce earlier because the outlook going forward is positive by the company.
Okay, all right. Sonal got that. In fact, the stock's holding up in positive territory, about 3% higher on the back of those expectations for a better second half. Some more names. In terms of early earnings reactions, the likely reactions as the market opens out. Shri Cement, by the way, like we were saying, the expectations were low. But the fact is it's lower. I mean, year on year, the numbers and the performance is not that great,
but the
perhaps.
Volumes are very, very low. You know, in pre-open. So it's only 1,500 shares that have got traded.
So maybe it gets picked up once we actually get to the real trading. So Shri is going to react. Jubilant is up about 4% right now in the pre-open. And by the way, the stock, GE, Vernova, TND, which Vamakshi flagged for us yesterday as well, it was up 5% on circuit because of great results. Even this morning, there's a lot of sort of excitement around it. So let's see if that good showing can continue. So today, for a change, we do have some positives from the results coming through after yesterday's major accident, which was, of course, Asian Paints.
And Asian is higher? I mean, let's just look at Asian Paints as well in the pre-open and take a look at
it's flat, I mean, with a slight negative bias.
1/3% lower. I don't know if Mitesh is still with us. Mitesh, any thoughts on Asian Paints, if you want to come in, levels-wise?
Yeah, Prashant, yesterday, obviously with the numbers coming in and slightly on the negative side, the stock, actually has broken some pivot points. And the last pivot is around 2,520. And we did test that intraday and managed to bounce back above that. But my sense is that looking at the indicators that this level could also give in, and we could see in the worst case scenario levels around 2,200, 2,250, and then some kind of reversal might happen. So I think for the time being, my belief is that this is a sell and rallies. Anything close to about 2,600, I would want to go short, or even suggest people take some short positions with a stop of about 50 odd points.
Okay, got it. By the way, we've not had a chance to look at Reliance in a while. RIL, Mitesh, how is that one looking?
See, Reliance very oversold, but I don't know why it's not giving any kind of a reversal sign as yet. You want to see some sideways activity here so that some, base building can happen, and the zones are also attractive. I think, around 1250, 1240, there are some monthly historical pivots coming in. So my sense is that I hope that, around these levels, you can see some reversal happening. But as of now, it's not happening. And I've been waiting for it for a number of days now.
Okay, all right. We'll come back to you with more, Mitesh. Thanks for now. We get market open in a few seconds, and as the GIFT Nifty showed, it's perhaps likely we get a higher start, 1/3% around. So there you go. First trades 24,223 on the Nifty. The Nifty Bank is starting about 0.3% higher. The sensex is up 1/3, and the mid cap index is up about 0.6% as well. So that is the overall picture which is coming through. Look at advanced decline, 1,000 higher, about 500 lower. I mean, it's a decent 2:1 advances to decline ratio, but this is still very early. So maybe in at least 15-20 minutes, and the advanced decline starts to be a little more credible. We got 85-point gain on the Nifty, the heat map showing that everything, 36 odd names are in the green as we begin this session. So almost 100-point gain is what you have. I mean, look at that. The two big losers are Asian Paints and Britannia. Not big, but I mean, two of the few names which are in the red are Britannia and Asian Paints. Otherwise, it's broadly up and in the green. Surabhi.
You know, that's the thing with Britannia. I know Mangalam was pointing out how the volume number is absolutely in sync, but the market's perhaps in that mood where if there's something wrong with the number, the market just doesn't like it. And despite that 5% fall yesterday on Britannia, why is the stock selling off today? Because look at the margin compression. I mean, it's not something you can ignore that lightly. From a margin of 19.7% in the same period last year, the margins now come down to 16.8%. That's serious EBITDA margin compression. And that continues to be a bit of a niggle. Maybe at some point buyers come in, because now with this 2.5% decline stock, we're talking about stock down 7% in a matter of 2 days. Maybe the buyers will come in. Anyway, moving on beyond Britannia, ONGC is the best performer on the Nifty. Of course, earnings also came through up and about. Hindalco, like Nigel is explaining, thanks to the India business. There's lots of green on the screen there as well, 1.5% up. Tata Steel is actually also positive. And you have a couple of the financial stocks that are starting off strong. ICICI Bank is up and about. There's SBI Life, there's Bajaj FinServe, Shri Finance. So, lenders, non-lenders, insurers, mix of financials that are doing quite well. Even HDFC Life is up and about. Trend is up 1%. Remember, yesterday we were talking about the Goldman Sachs target. I think 8,000 was their call on the stock. So it continues its good showing from yesterday. On the downside, beyond Britannia, Asian Paints, which is still lower by 1.5%. Then there is Dr. Reddy's, Cipla, some stocks on the way down. Actually, it's more FMCG, just lackluster. HUL, Nestle, a lot of these other stocks as well. Slightly red as we begin the day.
Well, Surbhi, the stock to focus on is UPL. Yesterday, the stock ended virtually at the low of the day, but I remember in CB we had pointed out that the company has maintained its guidance, and some of these stocks like Loris, UPL, the street gives them that long handle and says maybe the next quarter or the next one will be even better. Now, they maintain their guidance. They're saying that EBITDA growth of around 50% is maintained with operational cash flows of around $300 to $400 million. So that explains yesterday, after being down by close to around 6%, it's bounced back by close to around 5% today. Triveni Turbines, that's the other stock that's opened up. Gap up, so good up move is what we're seeing on that stock. Another big underperformer is HLE Glasscoat. It's been one of our rank underperformers, but that stock has opened up with a gain of close to around 10%. It's one of the top gainers. Volume's not very, very high, close to around 60,000 shares, but that one has opened up higher in trade today. So good up move is what we're seeing. The other couple of stocks that are reacting to its numbers, NMDC, we told you the numbers are disappointing. The stock is down close to around 2.5%. Quarter 3 will be far better because of the price increases they've taken. So let's see whether or not there is some recovery from those lows. The other couple of names that are doing well, LTTS is up 2.5%. Ramco Cements is holding with a gain of around 1.5%. So though those numbers are blockbuster, the street is still concerned that yes, there could be concerns because two new players are entering into the South market, Ultratech as well as Adani Cement, and that will make things rather challenging. So actually that stock has come off the high point of the day. So it's a good start, Prashant. 80 points higher. The 24,350 mark, that's the first resistance zone. So it'll be interesting to see whether or not we can get closer to that. But the Nifty Bank already above 52,000.
Absolutely. Rate gain will come up on your screen. It's, I think, got some volumes and it's down 7%. I mean, it's a fairly well-owned stock in the sort of travel SaaS space. And look at volumes, about 140,000 shares on rate gain. I think numbers came in the last 48 hours or so. That is taking a bit of a knock. What else? I think NMDC, of course, NMDC Britannia we mentioned. Piramal Pharma is down about 3.5%. And it's been coming off pretty sharply. So the high 3 days back was about 310 and stocks at about 260. 310 to 260 in just 3 days flat. PGEL, which is Electroplast, the EMS company, yesterday's high was about 710, stocks at about 630, is down about 3%, it's got volumes on it. We just spoke with Aums Drugs, 5.5% lower, and it basically listed at close to, I'll tell you, about 900 rupees, not very long back, about 15, 20 days back. And it's already at about 680 right now. So that's coming under some pressure. HG Infra is down about 4.5%. And then you go down the list, volumes are, of course, a little lackluster. Vari Energy, by the way, once again, is the biggest volume-led gainer. It's up about 3.5%. So Vari, of course, the high was about 3,700 4 days back. Stocks at about 29.30. But today it's already seen a bit of a move higher. Triveni Turbine, I'm not sure if you mentioned it, 8.5% higher on Triveni Turbine. It's a big move. There's JSW Energy, GE, T&D, etc., which are coming up with strong gains. Surabhi?
On Triveni, I went back to check the investor presentation because the numbers had come yesterday. And yeah, the numbers are absolutely fantastic. 30% top line growth, 320 basis points margin expansion. EBITDA surged by about 45%. So it's been a blowout quarter and the stock's getting rewarded for that. So this is one mid-cap that's definitely catching the headlines. And the other one would be, of course, Jubilant FoodWorks. Like Manglam pointed out, the pizza is tasting good this quarter. The gain is now almost 6% on Jubilant as well. So some, after a long time, we're seeing some positive, pleasant earnings pops this morning.
Absolutely. We should just mention one more name if we have it, if we can pull it up. Pix Transmission, I think it's called. I'm only mentioning it, never mentioned it before. 7.5% higher, but look at the volumes on it. I mean, I think it's a fifth or the sixth largest volume traded gainer right now. There you go. That's the one I'm talking about. Okay, volumes not showing, but on my screen, volumes are very large. So we'll, value traded is pretty large for now. About 12,000 shares odd is what it's traded. Gautam Chachoria is with us. He's head of Global Markets India, and Sunil Thirumalai is head of Emerging Markets and Asia Equity Strategy at UBS Securities. They're joining us now from the sidelines of their India Summit 2024. Gentlemen, great to have both of you here. Good morning. Prashant this side. Thanks for joining in. Gautam, come in. I mean, it's an interesting time to hold the conference, but I reckon there'll be a lot of questions. I'm not sure if there'll be many answers because you've got this big change in the US and you've got in Asia all this thing with China. Here in India, a lot of FII selling. What to your mind? What are the 2 or 3 most important questions you expect to hear the debates in India with regards to the Indian market to be around?
Morning, Prashant, and good to talk to you and the team. You made the right point. There will be a lot of debate around what happens to U.S. policy and politics, and we have expert speakers around that in the conference. And the other thing will be around the policy making locally, including reforms. So we had a successful macro trip to Delhi. We took investors to meet various policymakers. We do expect to have one of the government ministers talking on the same in today's session. So hopefully we get something out of that for our investors who, again, just to highlight, the interest in India still remains very, very high. In fact, the number of investors we are seeing this year, including from overseas, is at record levels versus recent history over the last many, many years. So the interest remains high, a lot of questions, a lot of uncertainty. There are enough corporates to answer bottom up, but yes, there will be top-down debates around both US as well as local policy making.
Sunil, good morning and good to speak to you as well. To your mind, I mean, in India, I mean, of course, there's this FI selling, and it's often difficult to distinguish, what is the head and what is the tail, and what's the trigger for all of this selling. But earnings have not presented themselves in a good way. It's been a pretty bad earnings season, Q2, and now all hope on H2 in that sense. What is your own sense, Sunil?
Yes, good morning, Prashant, and good morning to all the viewers. Yes, so it has been a fairly weak set of earnings. If you just look at it in terms of number or the percentage of beats, it's the lowest in the last 9 years, except the COVID quarter of March 2020. I think the silver lining is that a lot of the companies have actually come out and said, while September as a quarter was weak, the festive season, which actually fell after the close of the quarter, which is the month of October and early November, probably some signs of pickup are there. So we need to see whether that lasts. In the past, there have been years when the festive season pickup has continued, and after the festive season, and there are some years in which it has actually fallen off. I think consumption slowing down is the primary worry. Consumption across discretionary, across staples. We need to see whether that sustains. But otherwise, I think if you're looking at the banks, there are mixed numbers. There is credit growth slowing down, but asset quality has been some parts there have been worries, but other parts are okay. Yes, I think the quarter itself was fairly weak, but I would say there are some positive points that have come out afterwards.
Yeah, absolutely. I guess this is one earnings season where you cannot paint a sector with the same brush. Within a sector, companies have performed very, very differently. So it's more granular and more nuanced than normal. Take that point, Sunil. Gautam, just to get back to you, the Indian market has finally seen consolidation after a long time, right? Now it's almost 6 weeks of consolidation, fair amount of FPI selling. What do you expect ahead? More of this or a further downside, or at some point do you expect the foreigners to come back?
So first, let me say what Sunil has been publishing. He has been underweight India related to emerging markets and remains so, given valuations and earnings growth expectations. If I talk to Sunil here, our economists, our analyst teams, and investors, my sense is that the consolidation may continue for a while till we see clear catalyst. Catalyst will be, I would say, 3-4 things. One is some visibility around high-frequency data points and growth picking up. Sunil mentioned about festive season data points. Does that continue for the next few months? That's one. Second, to me, a very big one is the policy stance, both fiscal and monetary. We have seen it not being loose or supportive enough of growth in the last few months. Do we see a change in that? So that's the second part to watch. Third is reforms. Post-elections, we haven't really seen a big reforms push or agenda. Again, if that happens, that will be the third catalyst to watch, and we'll see if that happens post state election results and even US election results. And finally, what happens globally, like you mentioned at the beginning, what does Trump do, US policy stance, etc. So these are the four things to watch out for. Till then, it will be consolidation. Once we see clarity on these 4 things, mix and match, we should see support for markets thereafter.
You know, Gautam, it's really interesting that you're bringing up India's policy response or policy stance, because this is something new in the narrative that we've not been hearing so far. Because I don't think the growth concerns were becoming that real. Today we have the consumer inflation numbers coming through, and that's a very sticky sore spot. But really, do you think that, the growth weakness has become that entrenched that it requires both monetary and a fiscal response?
I wouldn't put it down that simplistically, that it's linked very, very directly or linearly. But yeah, that has played a part. Like fiscally, if you see, the spending is not what has been the case for the last 3-4 years, while the tax revenues keep on surprising. So the fiscal consolidation is happening faster. It happened much faster in FY24 than markets thought or what government forecasted. Same seems to be the case for first half, where the full year forecast seems very, very easy to achieve. Any fiscal consolidation is a drag on growth at some level. And even from a RBI perspective, again, we all know the inflation prints, and that's possibly creating some constraints on RBI to loosen up. But again, the liquidity stance or the rate stance is not helping. Like you can quote the CPI, but at a core inflation level, real rates are quite high. So again, the RBI's policy dynamics is influenced by the CPI print, but because of that policy stance, it is causing some constraint on growth activity.
Got that. Sunil, from your published universe, right? I mean, I'm sure stocks would have come off varying degrees. What is now looking attractive, Sunil, from an overall perspective?
So yes, I think if you actually look at the entire universe, one sector that is still trading below its long-term history of valuations is actually banks. Right? So, it's a sector which is FII heavy. So when there is heavy FII selling, the sector tends to underperform. There have been concerns on, credit growth being much faster than deposit growth, and that has to be reversing, etc. And we are seeing all of that in the numbers. So, we would definitely look for selective opportunities, within banks. In the macro trip yesterday, I think the key takeaway was that the government acknowledges that there has been some slowdown in the capex spending, but that could be a temporary thing, and they intend to scale up in terms of the spending, which means that the visibility for some of the industrials names could still remain. Even they have actually come off quite a bit. Where we would be a bit worried about is on consumer discretionary that is leveraged, that's based on borrowing with a retail loan and doing that consumption. That's where we would be a bit more worried about.
Have you guys published anything on implications for your coverage universe in terms of higher tariffs out of the US? And I mean, just broadly, I'm sure that's top of mind as well. And which are areas which are most impacted, etc.?
So, I mean, I think the good thing is that India is way below the global rankings in terms of what our trade with the US is, and there are many other countries in Asia and other parts of the world which actually should see that as a bigger problem. But nevertheless, it's not completely off. I think in the past, if we go back to the last term of Trump, there were some issues, not so much on tariffs to Indian exports into the US, but more on India's tariffs on our imports. That seemed to be one point that was brought up. There were also some issues around visas for Indian IT services companies. But otherwise, I think tariffs as such is a bigger problem for many other markets, many other countries. Not so much for India. On the other hand, if some of the other non-tariff campaign promises of Trump are also relevant for India, right? I mean, if there is a scale up of fossil fuel production in the US, and that helps bring down, let's say, crude oil prices or gas prices, India as an importing economy, could benefit. Net, we would say India is largely balanced or indifferent compared to many other markets which see a big swing and could see a big swing in their fortunes.
Okay, all right. Gentlemen, we'll leave it there. Sunil, Gautam, thank you very much for joining us here on CNBC TV18 this morning. Good luck with the conference, and we hope we get an update in terms of what the takeaways are post the conference. Thank you very much for being with us here on the program. Well, I think, Nigel, we have the management of Shri Cements with us.
Well, let's get straight to it. We have Mr. Neeraj Akuri, the Managing Director of Shri Cement, who joins us on the show. Hi, Mr. Akuri, and good to speak to you after a while. Well, the past quarter was more or less in line, but the street wants more. So let's find out what's the way ahead from here on. Now, in the past quarter, clearly you're focused more on value rather than volumes. What is the strategy from here on? At the half-year mark, it appears volumes are more or less in line. It's flattish in the first half of the year. Earlier, you all were guiding for 8 to 10%. So for the year, what will the volume number look like? And also on the EBITDA per ton front, what is it likely to be from here on? Given that you'll get some benefit of lower cost, volumes will spike up, as well as pricing should be stable. Please go ahead, sir. Both these parameters.
Good morning, Nigel. You are right. Last 6 months, the demand has not worked out in the way we were expecting. The country demand has been more flattish, and therefore, in the last quarter, we had very deliberately looked at of managing our revenues, managing our costs better. Going forward, Nigel, I am very convinced that the demand pickup should happen. The quarter 3 and quarter 4 demand for the year should be in line with our expectations. Already we are seeing some green shoots, and therefore we'll be back to our strategy of driving both volume and value in the coming quarters. Next year, of course, some of our new capacities will be coming online, and there we do expect that our growth should be in double digits.
Double digits in FY26, but what about FY25?
So
what should you grow at?
We expect the remaining 2 quarters to grow at about 8 to 9%. I am still very convinced, Nigel, that in cement there is nothing called destroyed demand. It is only a delayed demand, and if this works out, this is true, then quarter 3, quarter 4 we should be back on 8 to 9% demand growth, and if that happens, we will be growing in line with the market.
Okay, all right. So for the year, then I think it should be ballpark between 5 to around 6% growth for Shri Cement on volumes.
5% is what I would be expecting, yeah. 5% demand volume growth, yeah.
Got it. On the value terms, you've done a fair bit of work because the premium sales as a percent of your trade mix, it's moved to 15%. I didn't think in the previous quarter it was close to around 10%. So you're focusing on pricing as well. What does it mean in terms of an EBITDA per ton? The average for the first half of the year should be in that vicinity of around 850 rupees per ton. Second half of the year, how much better can it be?
So Nigel, EBITDA is a function of both prices and the cost. We are working rigorously on managing our cost lines. Last quarter itself, we have been able to reduce our cost by about 8% on YOY basis. These efforts will continue even in the coming quarters and coming year. So what we see is we will be doing a little better on cost, also thanks to the tailwinds from fuel prices moderation across the globe. On pricing, it is a difficult judgment. We would not like to make any estimate. It will all depend on how the prices pan out. But looking at the fact that we are expecting a better volume environment, I believe pricing should also play out, and we should expect better than last quarter pricing in the next two quarters.
Cost per ton will be lower even in quarter 3 in comparison to quarter 2?
No, I would say that quarter 3 prices will be better than versus quarter 2.
Cost. Pricing will be better, but your cost per ton.
Lower. We are working on this, that cost should be lower than what we expected what we saw in quarter 2.
So fair to say that a rough EBITDA per ton, since pricing will be higher, cost will be lower, volumes will pick up, and you know what I'm going to ask you next? EBITDA per ton should be closer to around 1,000 rupees per ton, sir?
So, Nigel, as I said, it will be wrong on my side to give you an EBITDA estimate, but looking at the overall set of growth of volumes, our constant work on the cost side, I expect the EBITDA to be better than what we have seen in last quarter.
All right. Mr. Kuri, you've been a veteran of the industry. You've been on the opposite side as well with some of the peer group. Do you think Shri Cement has missed a trick in the book by not doing inorganic growth? We have a couple of those assets, Kesoram, India Cements, Penna, Orient Cement, all of them have folded up in the competitors. You're still focusing on organic growth. Do you think you've missed a trick in the book?
Nigel, we are very convinced about our organic growth story. I think building a plant at $75 a ton is a better way to grow than buying at a very high price. This has been, at the same time, when we build to our designs, to our specifications. So, and therefore the cost of running those plants is also lower. I would say I am very convinced that our organic growth story has a lot of meat in it, and this is what we should be doing in future as well. Having said that, Nigel, please be aware that we are not against any acquisition opportunity. Whenever such opportunities come in the market, we do study them, and if it will meet our expectations, we'll be very happy to participate.
But Mr. Kuri, it's not converting. Studies is not converting into the final exam, because you all evaluate various plants, and I have my ear to the ground as well. Currently as well, you're looking at a couple of units, but it doesn't get into the deal closer stage. So as you said, you're building at around $75 per ton. If you're doing inorganic growth, what would be the valuation that you'll be willing to buy an asset? Some of these deals have closed at around $100, $110 per ton.
It's just not about valuation. It's also about strategic fit. It's also about the quality of plants. It's also about what is that we bring on the table if we make that acquisition. So it's a more detailed study, Nigel, and the capex cost per ton is just one part of it. Yeah. As I said, if it meets our requirement, our expectations, we'll be very interested to go for it. But currently is organic, which we are focusing on, and I think so far it has worked out well for the company.
Mr. Bangur, the investor actually has done well because Orient Cement, I think, he had a small stake of there, 1.5%, and I think he's made close to 2.5 times to 3 times that investment. So good on him. Mr. Bangur, the investor, has done well, but I think Shri Cement on the aggression front in inorganic growth, they have been lacking. Final question. There was an income tax survey that was carried out. Have you heard back from the income tax authorities? By when do you expect some kind of closure on this front?
No, currently some of those claims are sub judice, so it will not be right for me to comment, Nigel. We do believe that we have done the right things and that we will, the law will prevail, yeah.
Mr. Khoury, it's been good speaking to you when you were on the opposite side, in other cement companies as well. Thanks a lot for joining in, giving us your analysis of how you see industry as well as Shri Cement's futures. Thanks a lot for joining in.
Thank you.
All right. Thank you very much. That's the Shri Cement's management. We have the market, by the way, which has come off very, very sharply. We were up about 100 points, but just about 8 or 10 points left. Actually, now we're in the red, so 24,143, and we've been trading just for about 30 minutes or so. We have the management of PG Electroplast now joining us on the program. Second quarter numbers have come through, and I think for the second straight quarter, they've upped what they said they will do for the full year FY25. After Q1, I think there was a bit of a lift. After Q2, we've seen something similar as well. Vikas Gupta is Managing Director Operations at PG Electroplast. He's with us. Mr. Gupta, good morning. Good to have you with us here. Thank you for your time. So, I mean, this is the definition of what people or investors want to see. Quarter on quarter, you're raising what you think you'd do for the full year in revenues and profits. Describe to us, the business environment. Is it getting better and better? And just take us through segment-wise prospects as well, what you've seen.
So good morning, Prashant, and it's always a pleasure to talk to you. So what we see, like we have revised our guidance for revenue to 4,250 crores. So we see a very strong momentum and very strong order book for us in all our product categories like air conditioners and washing machines and air coolers. And the overall revenue growth is driven by our focus on our product business. So when we break down our revenue guidance of 4,250 crores, I think almost 3,000 crores will come from product business, in which air conditioners alone will be almost around 2,450 to 2,500 crores. Washing machines will give almost around 450 crores, and air coolers will give almost around 70 odd crores. And then our electronics segment will also give us almost around 300 to 350 crores. And molding should give almost around 900 crores. So that's a breakup of our revenue guidance of 4,250 crores.
Okay. So what is sort of making you most confident? And can you give us a little more color on the product business itself? The product business contribution came down from 75% to 54% quarter on quarter. So, I mean, as all the business lines continue to fire up, what will the mix be? And what is giving you the optimism on this higher guidance?
So please understand, as we are entering the AC season and we have a very strong forecast from all our clients, we have already recently added new capacities on our plant in North in Bhiwadi. Then we have further expanded our capacities on our plant in Supa in Maharashtra. And the kind of order book that we have and the forecast, so we are very optimistic on upcoming AC season. So we have already tied up for our numbers till end of March. So that looks very good. In washing machines also, we have added quite a few clients and we are further expanding our capacities in washing machine business as well. So we are quite confident on those numbers.
All right. Hi, Mr. Gupta. The numbers look good. You have raised your guidance. So good on you. But what about this QIP you've announced? Couple of questions out here. By when should we hear this QIP announcement? When do you intend to raise money by this fiscal year?
So, good morning, Nigel. So, yeah, we are looking to raise this money within this financial year. Okay. So, basically, we are trying to see, because we are seeing very strong growth momentum and there is a increased working capital intensity. Though largely to fund our working capital requirements, to further fund our capex requirements, we are looking to raise some funds.
Okay, so no inorganic growth.
So as of now, no, but we are open to all the ideas.
Give us further clarity then. This money that you'll raise, will you be using it for backward integration? Or are you looking at a segment where maybe volume growth will be okay, mid-sized, but you'll see better margins? If you could give us some clarity on what's the thought process.
So, Nigel, please understand the basic purpose of raising this money or funds is to largely fund our working capital requirements. And regarding the margins, we have already given the guidance on margins also. We have upward revised our net profit guidance to 250 crores. So the margins also look quite robust that way.
So it'll be better than what you're doing currently. This this more money that you're going to be raising and then trying to scale up the business.
So we are not factoring in our revenue in our revenue guidance this QIP money. So so we can't talk about that right now.
No, but I want to understand, you must be having a minimum margins, minimum ROC, some threshold that you'll be having in mind, right? When you put in money, what could the potential asset turn be, the returns that you'll be looking at?
Oh, so regarding the QIP money or the further capex that we do or any kind of allocation of capital, we have a guardrails already defined. We are looking at the asset turns of at least 4 to 5. And maybe around the ROC of around 18 to 20%. So that is the minimum kind of guardrails that we have going for any kind of capital allocation to new project.
Got it. Because, I remember this was last quarter, maybe the quarter before, you'd said that you were looking at entering an allied line of business. Apologies, I want to confirm that. Has it already been announced or are you still looking?
So we have not announced anything on that. That is still on the paper, and we are working very actively on that. Maybe in coming few weeks or maybe coming few months, we will be making some announcement on that.
Okay, and that's going to be done organically. I mean,
yes, definitely.
Okay, all right. We'll leave it there. Thank you very much for your time. Good speaking with you, and look forward to that announcement, as you said, next couple of weeks or maybe a month or two. We slip into another quick commercial break here. Markets are flat after being up quite a bit. Just as we take that break, a reminder, CNBC-TV18 celebrates 25 years of excellence. We invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit on the 14th of November, which is day after, starting 10 a.m. onwards. A power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more. Only and only on CNBC-TV18. Do join us.
Welcome back. You're with us on Corporate Radar. And as far as the market goes, it's very flat trends right now. So the market's not been able to hold on to the opening pop at all. That's a bit disconcerting. Mid-cap index is still in the green, but not by too much, just about 0.3% thereabouts. If we talk about some of the key movers on the index, Trent is still seeing buyers. So this dip on Trent, the stock being almost 20% off its 52-week high. Now there are buyers coming through. But the weak names include the likes of Asian Paints, Britannia. There's HDFC Bank that's turned quite weak, even IndusInd Bank. So some of the banks are, the key culprits in terms of why we're seeing a bit of a deceleration in the market early on this morning. Let's move on then. L&T Tech Services is the next company on the radar. The company has entered into an agreement to acquire Intel Swift Software India Private Limited and Intel Swift Software Inc. for $110 million. To talk about this development and to understand the strategy behind it, we have with us the company's MD and CEO, Amit Chadha. Mr. Chadha, great to have you on. Thanks so much for joining in. So can you tell us what the thought process is, what's the rationale, and some of the financials as well? What are the margins of this acquired entity, and will it contribute positively to L&T Tech's margin profile?
First of all, I'm excited that this allows us to deepen our expertise and get after more than 45% of the pie, which is about $80 billion of ER&D, so outsourcing. So 45% of that is in software development and platform engineering. This allows us to do that. Two, this allows us to get after more profitable sectors, as in fintech and retail, which we did not have in the past. Gets us to $2 billion faster. Addition to that, I had committed at different times that our aspiration is $1.5 billion by March 25, allows us to do that. Now, in terms of margins, one, we had committed to 16% levels in the current financial year, which we will achieve, and give us till January for us to come back and lay out the path for the rest of it. Because, of course, this is an all-cash deal, and we will have a little bit of a depreciation charge or amortization charge that will come in. So you will have to allow us January to be able to come back to you to lay out the plan there.
Fair. That's a fair ask. We can wait for a couple of months. But just basic question. This new entity, it will be margin accretive. Is that the right way of looking at it?
I will come back to you in January about this, if that's okay, because we are still working through it. There is 2 or 3 things that are playing, and the reason I'm saying that is, number one, see, the focus has been to try and get more market share, be able to get into areas which are high growth, to be able to pivot on growth. And we have talked about this in the past as well, that we are moving to be a growth-oriented organization. Number 2 is that our organic business continues to operate, and we have a playbook to operate at that 17-odd% EBIT levels. And we have a playbook that allows us to do that. Now, we've made investments in the first half of the year. We have talked about the fact that we will come back in Q2 and Q3 and Q4. You will have to let us go through that trajectory. And, sometime in January, we will let you know as to how the trajectory looks for in FY26.
Amit, could you tell us what is the historical growth rate of Intel Swift? And in terms of revenues, why is the revenue decelerated? Because, I mean, if it's targeting fast-growing areas, shouldn't revenues be expanding quickly?
A couple of things here. Number one is that, Prima, this is actually a high-growth area for them. They've done some switch in and out in terms of what they've been able to do with clients. In fact, some of their relationships that they decided to exit, which were smaller ones, etc. So they are now, if you look at it, 80% of their revenue is from their top 25 accounts, which have been there with them for more than 5 years. 4 or 5 hyperscalers are customers. In fact, 3 of those hyperscalers are customers for us as well. And given the size, which is 10 million plus accounts that they've got, and in addition to ours, will be able to immediately help us in terms of growing. I do not want to pass judgment or comment on what they did in the past, but I have met the leadership team. We have got details, we have taken feedback from our own customers, and they seem to be in that spot where they are poised for growth. In fact, I will go out again on and say that I'm confident for the plans we've created right now that we should be able to double IntelliSwift revenue in about 3 years' time.
Okay,
and
all right, so
we've seen that kind of growth for ourselves with the hyperscalers and in a similar market that we are addressing as well.
Okay, so you're looking to double IntelliSwift's revenues over 3 years. We've noted that. Let's talk about this year, because your revenue guidance is about 8 to 10% growth. Now, with the acquisition coming in, will it add to this guidance? Basically, will the revenue be higher than your guided band?
Our pipeline, like I talked to you in October, remains robust. In fact, we've been spending time across Europe, across the US geographies, and we are on track to be able to deliver our guidance that we had, our organic guidance that we had talked about, as well as the margin trajectory levels we had talked about.
Amit, last quarter, you guided for tech to do much better in third quarter. Sustainability to do well, mobility to be muted. Could you tell us how is the demand situation panning out? And just your thoughts on the US election outcome. How is that likely to be a factor at the margin?
So rather than commenting on the quarter, what I would tell you is that definitely with the elections behind us and the results clear, there's a lot more certainty in the environment. There are 3 areas that we are continuing to see demand across US and Europe. One is automation, as well as a lot more regional supply chains coming up, and therefore work for us in the sustainability sector, which is our sustainability vertical segment. We are seeing continued demand and deals in the consolidation, vendor consolidation area for mobility. And in the tech space, we continue to see spends expanding in AI, software, compute, and storage, as well as software. And all these three bode well for HDTS. In fact, we are on track to deliver what we had committed to for the quarter, as well as going forward into the year. So I would, if you want one word, I would say cautiously optimistic, CY25 being a better year than CY24.
Okay, so the next calendar year is going to be better than the current one. That sounds good. And now that you're saying that there is more certainty in the environment, should we expect slow-moving deals to pick up? Will decision-making be faster?
You should expect that, and it may start happening sometime, some of that in November, a lot more in Jan, Feb, as you look at it. The good news is that our financial year only starts in April, so we will get advantage with the tailwinds coming in from there.
Okay, all right, got it. Amit, we'll leave it there, and good luck with assimilating this new company into the fold. And of course, we look forward to another round of conversations after January. Like you said, you'll have more clarity on the numbers by then. Back to the market. So there's a bit of a green flip back on the Nifty for what it's worth. The stocks that are leading it higher. Interesting split between ICICI Bank and HDFC Bank today. Look at it. I mean, the two are moving in totally different directions. ICICI Bank is 1.5% up. HDFC Bank has been, exerting downside pressure. So that was a bit of an interesting trend. Anyway, let's look at some of the numbers that have gone down well today. And Jubilant Foods is definitely one of them. I think we'll have Mangalam join in just a bit on this. Yeah, I think, okay, Mangalam will join us in a bit. Now I see him. Can we go to Mangalam?
Yes, you can.
Okay, brilliant. So the pizza is tasting good, but the cookie, 50-50, it's still a little red.
The cookie is still a little red. The pizza is actually tasting very good. Revenues at around 1467 crores. The street likes that, in line with these numbers. The EBITDA as well, 287 crores, largely in line with street expectations. What was good was the internals. The Dominos like-for-like sales growth came in at 2.8%. The street was working with a number of 2 to 3%, but 70% of their revenue, remember, comes in from delivery, and delivery like-for-like growth was 11.4%. That's telling you that after 8 or 9 quarters of weakness in the QSR industry, we're seeing some signs of early pickup. We saw that in the last quarter, and now it seems to be building on. With the third quarter underway, let's see how that pans out in the second half of this year, which is typically stronger for QSR consumption itself. They've added 50 new Domino's stores during the quarter. The street was working with a number of 45, and the average daily sales of mature Domino's stores is at a 6-quarter high as well. 80,185 rupees odd is the average daily sales of a mature Domino's store. The sales mix, 15.9% growth is what we saw in the delivery revenue. Dine-in, now this is a structural decline that we've seen in QSRs, where dine-in has actually underperformed for the last many quarters because people are not going in anymore, they're ordering out, and as a result of which dine-in has declined, and delivery, which was almost 50% of their sales pre-pandemic, has now jumped all the way up to 70%. The street likes that. The cookie, however, is weaker because of lack of cream in the middle. That's the EBITDA. If you look at Britannia, revenues grew pretty much in line with expectations. The volumes grew by about 8%, again in the top quartile for the industry. But remember, the EBITDA was a sharp miss as against street expectations, led lower by gross margins as well as lower by higher employee expenses. Though the company has clarified to us that 50 crore of those increased employee expenses, are one-off in nature, as a result of which the stock has come off the lows. And at 10, we have the management con call as well. So we'll hear out on the near-term commentary for Britannia. That'll be more important for the stock price movement than what happened yesterday overnight.
So the employees at Britannia are definitely getting more than crumbs. Can we say that?
50 crores to be specific to be out precise. Here. So, I mean, that's definitely a lot more than crumbs.
Prashant.
Absolutely. Mangalam, thank you very much for that. Let's focus on UPL as well. But just a quick 5 seconds. I mean, Sagility is making it to the market. It's a 2% higher. It was a muted listing, muted start. We had the management with us. They're essentially a company which works with the US health insurance sector. They work with both payees and payers. So they work with hospitals. And they'll work with insurance companies as well. So it's largely a B2B business, but on the tech infrastructure side. So that is the listing. It's a private equity-owned sort of business, and bulk of course, what they are raising is through as far as the offer for sale is concerned. I think the private equity player is diluting 15% equity. 31 odd rupees, about 4% higher, 2.5 million shares traded so far. UPL is what we want to focus back on. Sonal is here with more. Sonal.
Well, yes, weak set of numbers reported yesterday. The stock also fell around 8%, but today there's a recovery because they maintained their EBITDA and revenue guidance for FY25. They are looking at a 50% EBITDA growth, cash flows of around $300 to $400 million, and revenue growth of 4 to 8% as well. That is what the street seems to like. In the conference call as well, they spoke about how there is some recovery that they're seeing across geographies. Entire recovery would come by only in FY26. They are expecting strong margin growth in second half. Destocking is nearly complete and normal ordering is in process. But yes, pricing pressure continues, something that other chemical and agrochemical companies have spoken of. That is because of overcapacity in China. The rights issue size is reduced from $500 million to $400 million. There's still an update to come in from the regulator, but this money will be used to cut down their debt. In terms of volume growth for FY26, looking at a 5% growth and expecting growth in every region in FY26. On the back of this, Nuvama says the potential rights issue and stake sale in Advanta is making them positive of balance sheet improvement. And that is the reason why they've gone ahead, increased the target price to 590 versus 486 earlier, and upgraded the stock to a buy from a reduce.
Okay, all right, got it. UPL seeing some recovery there after yesterday's drubbing. Thanks for that, Sonal. We need to take a quick break. And as we do that, here is a reminder. As CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit on November 14th, starting 10 a.m. onwards. A power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more, only on CNBC-TV18. Okay, let's quickly look at the market once again, which has been very range-bound, flip-flopping around the flat line. But the fact is that, we're not holding up the early morning highs. There's a fair amount of volatility in today's trading action. Let's go across to Mitesh and get some more ideas going. Mitesh, how do you read the opening, the trade so far? And what would the advice be on the index first?
Yeah. So, one, I think, the sell-on rally texture kind of continues. Yesterday also we had a bounce back which got sold into, and today a gap up has been sold into. The only, hope which, I'm looking at is the pivot at 24,000. If that sustains, it should be all good. But the buying zone, therefore, would be slightly lower from here, which is closer to about 24,000, 40, 50. So on the index, I think not doing much as of now, more of a wait and watch mode. What is also, turned slightly weak is the bank nifty, showing first signs of, tiredness at higher levels. But Nifty IT is good. So maybe explore long position in the IT segment and, trade with more of stock-specific bias.
Okay, all right. In terms of individual names, Mitesh, any new ideas, any new trades?
So on the stock side, as I said, I think, IT is something which I would want to explore longs into. Infosys, after a correction to about levels of 1720, is reversing very well and could, head towards 1940 odd zones. So keeping that as a target, Infosys is a buy. Keep a stop below 1850 rather, and look at a rally till about levels of 1940, 1950 on the upside. And the other stock, which I have is, and I'm observing this stock very closely because Glenmark had a very negative opening and has since then come back, but the gap still remains. So maybe a short trade over here with the stop just around levels of 1640 for targets of 1550.
Okay, all right, Mitesh, got that. We'll connect later in the course of the day. Thanks very much for those calls for the time being. Mitesh, actually, if you're still with us, if you could give any levels for Jubilant. After a long time, that stock is reacting positively to numbers, 6-7% higher. Does it interest you?
It does. So Jubilant is one stock which had a very good monthly chart. We saw the stock rally from 450 to about 700, complete a proper retracement and is now reversed. So I think the long-term chart should get well. The only issue with Jubilant for me is that there is a gap, which is a falling gap between 1st and 3rd of October. Around these levels of 650, 660. So I think once this is cleared, I think the stock is all on its way to get past 710, which was the recent swing high, and make much higher levels. So very, very positive. But for somebody wanting to buy, either wait for decline or wait for the 660, 665 zone to be cleared.
Okay, the other one which is coming up very strongly is Macrotech, Lodha. The lows recently were about 1,050. Stocks back at almost 1,300 with this 7.5% pop today. So keep an eye out on that one as well. That is Lodha Develop, Macrotech on your screens now. We'll take a quick commercial break here. Mitesh, thank you very much for joining us. We'll chat again. Lata will be in conversation with Santanu Chakrabarti of BNP Paribas as they review the second quarter bank's earnings. Santanu, of course, is India analyst, BFSI at BNP Paribas. That's coming up.
Welcome to our earnings discussions. For the banking sector, the Q2 result season is over. We went to the quarter fearing higher cost of deposits and therefore lower bank NIMs or margins and higher unsecured loans or NPAs. But at least for the big banks, say the SBI, HDFC, ICICI, Axis variety, the results have actually been a positive surprise on all these quarters. And now what are the trends for the current and for the next quarter? Will margins rise? Will they remain flat? Will deposit costs start falling? Or, are all these going to remain flat? And more importantly, what about loan growth? Because we have seen a soft quarter behind. Deposit growth has been higher than credit growth. So is there a loan growth issue in the coming quarters? For all these questions, I have with me Shantanu Chakrabarti, the India analyst, BFSI at BNP Paribas. Good morning, Shantanu. Thank you very much for joining us. I want to go and do the past as well, the results gone by. But first, a para on, how should we see? Like I told you, we went into the result season troubling ourselves that NIMs will be under pressure, deposits are going through the roof, stuff like that. Now, is all that behind us? Can we see margins rising in the coming and current and next quarter?
First of all, good morning, Lata, and it's a pleasure once again to be chatting with you. Thank you. Look, our view on this margins thing has been that as far as on a pre-cut, rate cut basis, margins for the most part has almost bottomed out. Whatever incremental pressures are there on margins or through cost of funds is essentially in single-digit basis points from here on out, at least for the major banks. The reason for this is that the FD repricing bit, which was a critical driver of increase in cost of funds, is over. And sure, as long as CASA doesn't pick up, your FD proportion within the book goes up. And therefore, to that extent, there could be a couple of basis points here, there increases in some of the cost of funds. But on a pre-cut basis, definitely margins are very near a bottom. And any move from here is small. And that kind of has played out. It's played out better in some cases than others, but that seems to be the broad trend. Now, of course, margins will bottom post-rate cuts, right? And from there on, we actually see that as a positive from there on out because we feel that CASA will pick up, FD repricing downwards will start and so on and so forth, and will set the base for a further margin expansion from that point out.
No, just come again. At the moment, the Reserve Bank is keeping liquidity comfortable. It's in contrast to what it was over the average of the previous 12 months. As you point out in your report, actually in the past 12 months, if you take the average, the Reserve Bank has been tight. So won't that itself start bringing down the cost of deposits? Or you still think that deposits will remain high?
See, in itself, just without headline rates coming off at all, I don't think there is further play downwards in terms of deposits. That would be a little...
So unless there is a rate cut, deposits will not fall, you're saying?
No, they won't. And especially since, FD is the primary supporter of growth at this point. And you would have already seen that the headline growth for the month has actually come off quite a bit. This is one of the first quarters in a long time where deposit growth has been actually slightly in excess of credit growth. A situation which we had discussed in an earlier interview with you, where I had said that, this deposit growth slowdown thing, it's not that much of a worry. But what starts happening is that you start getting pickier about where you want to lend and where you don't want to lend. And broad credit kind of slows down a little bit. The appetite for corporate loans has slowed down even further. Now, what started off with somebody who's going through a major liability restructuring like HDFC being not too keen on corporate loans, now becomes a larger group, which is kind of backing off from rates that they do not like. So, we have to keep all of that in context. And yes, it would be too bullish to assume that, deposit rates will start to fall pre-rate cuts. But post-rate cuts, definitely yes. But post-rate cuts, more importantly, easier liquidity and easier money supply should drive, car and SAR respectively back up.
Okay. No, I wanted to follow up with a question on loan growth, but you've already touched it by saying you are expecting pressures on loan growth. I'll come back to that point in just a bit. Let me now go back to the laggard results and then ask you some futuristic questions. In the results, is there a clear dichotomy? The big banks showed no pressure of unsecured loans, etc. But we did see that pressure once you come to a UCO, a Bank of India, even for that matter in an IndusInd because of its MFI, IDFC because of its MFI. Is there a clear distinction? Bigs did well. The mids didn't do all that well on asset quality.
And you remember in our last conversation, I was mentioning that credit access, Grameen early disclosures have serious significance for the sector as a whole, because this is one of the most well-known, perhaps arguably one of the best-run MFIs in India. And here it was in its pre-disclosures, despite being geographically diversified, reporting a fairly significant sequential decline. Now, that's a very strong signal as far as, asset quality on most other MFI portfolios go. Now, obviously, banks are a little better placed because, the liability support, at least is assured in their case to tide through whatever troubles that the MFI segments may face. So you'll see a lot of the underperformances that you're talking about, or disappointment of expectations rather for the quarter, have actually come from microfinance. Yes, most people have reported a slight worsening within unsecured. Even ICICI Bank came out and said that their unsecured NPAs are also up a little bit, but it's not significant in the overall scheme of things too much for to alter your credit cost prognosis in a material way. You might have heard that SBI actually is perhaps the only large bank which came out and said we are not seeing much pressure. If anything, people are very willing to refinance our customers out. But other than that, the primary driver of disappointments has actually been microfinance and not unsecured lending of personal nature.
Yeah, I think that was a very big takeaway from the results season. The Reserve Bank had put our antenna up, but it was not unsecured credit. It was microfinance, which disappointed and expectedly so, perhaps. Shantanu, you don't look at the public sector banks, but over there we saw some very good performances coming in from Canara, Indian, BOB. So do you think that there is a choice of banks to pick now that the market is also lower? Of course, the big banks are doing very well, but is there a choice over there? I know it's not you don't have a report on it, but just your qualitative view.
So let me mention what stance we have taken on SBI. And perhaps that would help at least form a framework around how to think about some of the public sector banks right now. So in SBI, for example, we had an excellent beat out there, right? But we actually downgraded from outperform to neutral. Because we put a target multiple of 1.2 times 2Q FY27 core. And frankly, in the absence of a very sharp uptick in credit, say a corporate lending cycle starts, or a very sharp uptick in current account, savings account for the system as a whole, through a sharp monetary or liquidity easing, that practically, is the ceiling of my comfort zone. Okay. Especially where, the probability of a very healthy valuation raise at this point, which boosts book value and so on and so forth. is a little lower, probably versus 2-3 months back. Markets are a little less robust. So balance of probabilities, I mean, going higher than 1.2 is tough for me. Now, some people would argue that SBI has guided for 15% sustainable ROE. But the thing about a 1% ROA bank is that, its leverage and ROE are the same. So, to get to 15% ROE, you basically need 15x leverage. And whether or not the regulator smiles on that, I mean, there is a certain arithmetic associated with 15 times leverage. There's a certain fragility which comes inherent in that arithmetic. And that's where I define my comfort zone. I'm sure that in the bull market, some of these things will trade up at 1.5, 1.6. But I don't
Your comfort zone would be 1.2.
Pursuing that,
Okay. Fair enough. So would you say, therefore, that for the second half, the worry about bank earnings will be actually the amount of credit growth? In the first half, it was margin. Second half, it is going to be, corporates are not yet borrowing and banks are afraid to lend retail because of this unsecured worry.
Right. I mean, it's not that banks are not lending, Lata. It's just that they've come off the, if they were going in 6th gear, probably it's now 3rd gear, right? Here's the conclusion that I'm increasingly coming to. That until rate cuts happen, and see, even on RBI's liquidity interventions, if you see, yeah, sure, they're more comfortable with allowing overnight surpluses. But on a net basis, they have still mopped up liquidity. They have not injected liquidity, even for this current fiscal, right? So liquidity needs to ease further. It has eased compared to earlier. And the monetary stance needs to change. So RBI, once it moves out of that inflation targeting mindset and towards a growth supporting mindset, and neutral is where its stance currently is when you'll see the pickup in credit growth, in our opinion. Because, unsecured, as you rightly said, coming off a high base, the growth rates are now not going to look great. Look at things like CV, etc., which was supposed to be the savior of growth. You see what's happening within IndusInd on CVs, which is clearly, I mean, whatever else you might say about IndusInd, it is very hard to fault the quality of its CV business, right? And some of those slightly higher yield things which were supposed to come to rescue of credit growth in the interim is not really playing out. It's not a major crisis or anything. It's just that probably the momentum isn't what one would have expected. So I'm starting to incrementally suspect that some amount of relief on affordability and asset returns through the prevailing interest rates in the economy would be necessary for a further uptick in credit growth. Now, I continue to assume, by the way, still a December thing, which is very counter consensus.
No, I won't buy that at all, because today the CPI number that will come will be perhaps 6 or even above 6. And that is the last number Reserve Bank will go into the policy with. I mean, they are in a tough spot. If GDP for second quarter comes at 6.5 and inflation is above 6, it's not easy for you to cut. Anyway, that aside, just a final question to you. This is not a banking question. It is your head of research or your strategist's question. In the scheme of things, where does banking stand? For the second half, does finance figure very high on your buy list, sectoral buy list?
Yeah, so BFSI has been an overweight area for us. It has continued to remain so for the last 1 year. Unfortunately, its relative attractiveness has only improved over the year, but hopefully it will work for us.
Okay. All right. Well, thank you very much, Shantanu, for joining us. I mean, your buys and the price targets have been anyway running as you spoke. And Shantanu's best buys are the top 4 banks. And of course, he also has Bajaj Finance as one of his top buys. Thank you very much, Shantanu, for joining us.
My pleasure, Pratap.
Okay, so I think the big takeaway is that we have to wait for credit growth. We were wailing about the higher cost of deposits. Now we have to start seeing credit growth because corporates are still not borrowing as much as was expected. Let's see whether the second half turns out to be good. Let me wind up by looking at the rupee market for just a bit, because it's hit a new low at 84.4. That was the level that got traded on the rupee, and this is largely in sync with all the Asian currencies. If you go on from bahts to ringgit to IDR, that is Indonesian rupiah, and the yuan, The fall is anywhere between 0.25% for today only. And but particularly the Indian rupee traders look at the renminbi. The renminbi has now gone to 7.23 to buy a dollar. Just before the elections on November 5th, you could buy a dollar with 7.1 renminbi. That is the pace at which the renminbi is falling, and that is to China's advantage. China wants it to depreciate because when the tariffs come, if the renminbi is cheap, more Chinese goods will still be bought. But how does an Indian trader look at it? As the renminbi falls, the expectation is that the RBI will allow the rupee also to fall because we have a big trade deficit with China. The renminbi becomes cheap, more Chinese imports will gush into India, which obviously neither the government nor the RBI want. And therefore, as long as the dealers are expecting the renminbi will weaken, they will expect the rupee also to continue to weaken. There will be only short positions on the rupee or long dollar rupee positions. The expectation is that the renminbi will go to 7.3. And therefore, let us be prepared for a little more weakness on the rupee. And the other big reason, of course, is that FPIs are still selling. Yesterday, you may have seen a 2,000 crore sell compared to a 4,000, 5,000 crore in the previous days, but it is still a sell. And there is no guarantee that today will not be another 4,000 crore sell from the FPIs. So pressure is clearly for a weaker rupee. We haven't yet seen the lowest point of 2024. On that note, let's wrap up on Bazaar, but with a quick reminder. As CNBC-TV18 celebrates our 25th year of excellence, we invite you to the most anticipated event for the year, the CNBC-TV18's Global Leadership Summit on November 14, starting 10 a.m. onwards, a power-packed day with several panels focusing on India's economy, our digital landscape, markets, entertainment, and a lot more. Of course, all will be available on CNBC-TV18.